The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A vibe check for markets as we count you down to the closing bells and earnings from Nvidia. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Gabelli. We're kicking you off through this close on this Wednesday, an incredibly busy news day. We're looking at an S&P that snapped its three-day losing streak up by nearly 1% on the back of hopes that the potential deal will be clinched between the U.S. and Iran, and that's why you're seeing oil slide as well. The big story is still the bond market, so that optimism pushed treasuries higher, but still we're seeing levels we haven't seen in a while. For the 10-year yield, it's now at 4.56, a level we haven't seen in roughly a year. For the 30-year yield, it's a level we haven't seen since roughly 2007. And we would be remiss if we don't talk about Nvidia. Of course, all else will be on Nvidia. This is the biggest stock in the market, and it's always been a beat and a raise the past few quarters, and anything short will be a disappointment for investors, Romaine.
And particularly tonight, Isabel, investors are looking for some sort of proof of life out of Nvidia that the AI boom does have more room to run. In fact, it was 3 years ago this week when Nvidia actually reported $7 billion in fiscal first quarter revenue. That beat estimates by the widest margin in 5 years at the time. But then came the Jensen Huang mic drop. He said Nvidia would reach a record $11 billion in quarterly revenue within 3 months. He exceeded it at $13 billion. And then 12 months later, double that to $30 billion. 18 months later, double that again to $68 billion. And tonight, it's projected to report revenue of about $80. So the question tonight, well, it isn't really whether investors will believe what is reported and forecast, but whether Jensen Huang's story still has the ability to surprise. Maybe it can. After all, Anchor Crawford told us yesterday the addressable market for AI services, that market is barely in its infancy.
Demand for intelligence and for tokens is up and to the right, and over the last, I would say, 4 to 5 months, it has only accelerated. So really, that is the key for Nvidia. As long as the demand is so strong, you'll need the chips that create or like satisfy that demand.
Of course, high expectations do set the stage for disappointment, and there is reason to be cautious. The run-up in valuations for Nvidia and the tech stocks orbiting around it have drawn comparisons to the 1990s dot-com bubble. In fact, the gap right now between the current price level of the Philadelphia Semiconductor Index and its 200-day moving average, it's at its widest ever. Let's kick things off right now with Greg Boutle, head of U.S. equity and derivative strategy over at BNP Paribas. And Greg, I've been asking everybody this question about whether it's even fair to draw parallels between what we're seeing today with the AI boom and what we know in hindsight transpired with the dot-com boom and bust.
I think drawing parallels is absolutely fine. Indeed, that's one of the things that we've been doing. But what you have to be careful is assuming that we follow the same patterns one for one. But we can certainly learn things from that episode.
So, well, let's talk about maybe what investors can learn from that episode with regards to maybe where they invest, maybe where they don't invest, and how they deal with what I'm going to assume is not just going to be a straight line up or down for any of these stocks.
Yeah, exactly. I think one of the key lessons that we take from the late 90s bubble was that these things can run a lot further and a lot longer than many think is rational. One of the key attributes of the late 90s bubble was that as the market went up, it went up against an increasing back of higher volatility. And that's something that we think is a regime that we find ourselves in this year.
And your positioning indicator recently hit overextended levels.
Yeah.
What tells you this is a healthy correction and not something bigger?
Well, I think that we can start looking at things like positioning within the context of some more fundamental quantamental metrics like earnings momentum, for example. So when we look at our positioning indicator, we've seen prior periods where it's got overextended and maybe it's healthy for the market to have a correction. But where you have things like earnings momentum very, very strong in the background, that tells you that a correction maybe is more of a localized thing than an end to the bull market.
And a lot of investors fear that higher yields will derail the equity rally, but you argue the opposite. Why?
Well, I think we have to look empirically at what's happened in prior cycles. And there are absolutely periods where a volatile, very quick, disorderly move higher in yields has been destabilizing for equities. But there have also been periods where we've had very large equity rallies against the backdrop of higher rates. So I think we're already talking about the late 90s parallels. When the Fed started hiking rates in, I think it was June 99, certainly the summer of 99, the NASDAQ went on to rally 100% in the next 9 months. So we're not saying we're going to follow that same path, but there are plenty of instances of a fat right tail for equities when rates are moving higher.
I'm curious, though, we talk about the right tail. I am curious about the left tail and whether anybody is, at least in sort of any aggregate way, doing any sort of mass hedging against it.
We see much less appetite for hedging at the moment, which is kind of behavioral and rational because it quite simply hasn't been working. We had what was potentially a horrible geopolitical shock in March, and hedging really didn't work that well. So we've definitely seen less demand for hedging, but people certainly do try and find smart ways to own the tail. People are not kind of oblivious of what's going on in terms of the meteoric rise that we've had for the markets. So there are pockets. You mentioned the semis. That's one where people are looking.
I am curious about the future. And because let's face it, for the last 3 years or so, roughly, if you wanted to bet on the future, if you believed AI was our future, you bought shares in Nvidia, maybe a few other companies, but Nvidia was the focal point. That could change in a big way later this year. We had a report earlier today that OpenAI is potentially going to file confidentially for its IPO. Everyone's expecting an IPO out of Anthropic. And based on Bloomberg reporting tonight, we may get that S1 from Elon Musk and SpaceX. What does that mean for the market?
Well, it certainly brings a different flavor to the bull market because the first stages of this AI bull market, these were corporates with massive free cash flows, fortress balance sheets that were driving a kind of earnings-driven boom. What we're having now potentially is some very large IPOs of companies that will have massive market caps, but don't quite have the same balance sheet or kind of cash flow dynamics. So for us, that's not necessarily bearish, it's not necessarily bullish, but it does create an environment, fatter tails, more volatility.
And investors who called the dot-com bubble a little too early got punished by a lot. What are the bars right now for making the same mistake?
Yeah, I think that's one of the lessons, that you can be right but get your timing wrong, and it can be very, very painful. So when we look back to the late 90s, one of the things that started to go off in terms of alarm bells at the start of 2000 were more misses, more warnings in terms of earnings. So we think keep watching earnings. We think that is one of the key metrics to stop buying the dip. Right now we think you should keep buying the dip, but if we start to see cracks in the earnings picture, earnings downgrade cycle, big profit warnings, that's what we think could end the party.
And very quickly, if you were to characterize this market, do you think it's overly optimistic or cautiously optimistic or just
I think it's rationally optimistic at the moment.
Rationally optimistic. I like that, Greg. Greg, always a pleasure, always insightful. Greg Boutle, head of U.S. equity and derivative strategy at BNP Paribas, and he was just talking about earnings. We're going to talk about that in just a bit. We got those earnings this morning out of Target and TJX. We get Walmart in the morning. We also got earnings out of some of the restaurant companies, including Cava. We're going to have the CEO here in just a second breaking down his restaurant chain's raised outlook. And of course, in just about an hour's time, we have full special coverage right here on The Close of those results out of Nvidia. Don't go anywhere. This is Bloomberg. Time now for our top calls. Some of the big movers on the back of analyst recommendations. And we start off with ASML. UBS naming the chip equipment company a top pick, calling for an almost 50% rally over the next 12 months to about 1,900 euros. That's about 2,200 US dollars. The firm saying it expects a more prolonged investment cycle into 2028, and that ASML is still one name offering attractive risk reward when it comes to the European semis. Those shares ending a three-day losing streak up strong, 6% here, the ADRs, I should point out. Next up, Packaging Corp. UBS boosting the containerboard and box maker to buy from neutral. UBS citing enough company pricing power amid tighter industry supply to overcome input cost pressures, and that still muted shipment volume. That stock, which had been flat on the year, having its best day this month. And finally, let's take a look at Newell Brands. This is the consumer products company behind Rubbermaid, Sharpie, Yankee Candle. Downgraded today to underweight over at Morgan Stanley, the firm citing macro pressures that could hurt demand for its products at a time when the company was already facing limited pricing power relative to some of its cost pressures. That stock actually, it had been down an 8th straight day and now unchanged here as we move closer to the closing bells. All right, we want to turn now to another big earnings report that we got earlier today, and that was out of Target. Phenomenal growth in the most recent quarter, signs potentially of a turnaround in this company under the new CEO, Michael Fidelki. Yet, you see the shares down almost 6% here on the day, partly because of some comments that the CFO, James Lee, made on the conference call. Joining us right now to talk a little bit more about this is Michael Lassier. He's He's equity research analyst of hardlines, broadlines, and food retail over at UBS. He's got a buy rating on the shares. Michael, first let's start off with the comp sales store growth rate. It obviously surprised to the upside, and even with the relatively cautious guidance that it gave, that was still an improvement over where analysts were looking for the full year going into this report.
Undoubtedly, it was a very solid result overall, highlighted by a 5.6% same-store sales increase. That's going to be on par, if not better, than what a lot of other retailers report for this holiday, for this reporting season. Now, Target's got some easier comparisons because of all the well-discussed factors that have been influencing its performance for a while. But keep in mind that the 5.6% same-store sales increase was driven by a 4% increase in traffic. That is the lifeblood of a retailer. If someone's going to come visit the store, visit the website, it's a reflection of how they're resonating with the consumer, they being Target. So I think that bodes really well for the outlook from here.
I am curious, though, because on the conference call, both Fidelki and to a larger extent, James Lee, talked about the consumer and the headwinds that they may be facing given the increase in gas prices as well as other household costs, and whether that would actually have a dampening effect in the second half on discretionary spending and to a certain extent even on spending on staples.
In this environment, Romaine, it makes sense to be prudent. The company outperformed what was expected both internally and externally in the first quarter. They're trying to just keep expectations in check. Now, those pressures the consumer is facing are real, so we can't ignore them. But what is driving Target's performance is some of the investments that it's made, some of the initiatives it's put in place, and some of the resonance it's having with the consumer. Our belief is that that is going to continue for the next few quarters at least, and most likely beyond, even in the face of a more challenging environment for the consumer.
Speaking of those investments, Target is betting heavily on store upgrades, beauty studios, and a lot of these food expansions. Do you think these are defensive moves, or are they more growth investments? What is your read on them?
I think they're the right moves. Those are categories that are resonating with the consumer, beauty, collectibles, home. Those are categories that Target has historically done very well in. They're resonating with the consumer. You are also right in highlighting the food and beverage, because that's a key traffic driver. In the case of Target, it needs to have a differentiation in its assortment. It can't compete head on against some of the larger players out there on a price for price basis. So having differentiated assortment is how Target's going to win in the marketplace. So we think it's making the right moves here.
And management said that this is a start of a longer-term turnaround and not a one-story quarter. What are the signs you're looking to be convinced that Target is indeed turning the ship?
It starts with a sustained growth in both same-store sales as well as traffic. If after a few quarters we see consistent performance on those top-line metrics, what's going to happen is the market is going to more likely believe that Target is resonating with the consumer, and that's going to translate to the market being more willing to give it a premium multiple and drive this stock higher. Our call is you want to be well ahead of that, and the indications that you got from this quarter are quite positive in the path ahead.
Michael, I do want to ask you about, of course, the other retail behemoth out there, and that is Walmart. They are scheduled to report earnings tomorrow morning. Obviously, a much different story from Target in terms of its longer-term growth and what it is. I'm curious as to where you think they actually fit into the current macro backdrop going forward. Are they going to maybe pick up business if economic conditions are a little bit softer, or is there another growth story here investors should be looking to?
Well, I think it's first and foremost, you have to keep in mind that there's 950,000 stores in the United States. So there is an environment where both Walmart, Target, Costco, and others can be successful simultaneously. I don't think the success of one is mutually exclusive with the success of another. Second, more specifically to what we'll hear from Walmart tomorrow, I think it's maintaining its momentum. Most likely it'll generate 20% or better growth from its online channel. That's bringing in a new customer that might not have interacted with Walmart in the past. And that has legs to continue for the foreseeable future. So the point here is that Walmart's being successful, Target's being successful, Costco's being successful. The consumer is consolidating its spend amongst these large retailers where they're offering great value and they're making it easier for the consumer to do business with them.
Yeah, absolutely, and that seems to be the big story here. The companies that can offer that value, or at least some degree of uniqueness, definitely doing better than the others. Michael, always insightful, love it. Michael Lasser, U.S. hardline retail analyst over at UBS. A closer look at those earnings that we got out of Target this morning, and of course, Team Surveillance, I presume, will have full coverage of Walmart earnings in the morning. Coming up, we're going to take a closer look at Airbnb. It's hosting its annual product event today. We're going to catch up with the CEO and co-founder, Brian Chesky, in just a bit. Stick with us. This is The Close on Bloomberg. All right, welcome back. Airbnb hosting its summer release today. Let's get right out to San Francisco right now, where Bloomberg Tech co-host is standing by with the CEO and co-founder of Airbnb, Brian Chesky. Ed, take it away.
Yeah, Brian, it's good to have you with us. Look, the way that I look at this newer offering from Airbnb, not just an expansion of travel services, right? More like Airbnb is an app store where developers can build for the existing customer base. So with everything new that you're offering, is this Brian Chesky in founder mode building it to grow it and launch it, or are you thinking M&A and buying it?
Interesting. Great question. So, I think you're right. What we announced today were 4 major services: groceries, airport pickup, luggage storage, and car rentals. But what I told everyone is just the beginning. You're going to see dozens of more services. And what we're building is an ecosystem of services for every part of your trip, from the time you arrive to the time you leave. It is a little bit like an app store in the sense that working with the developers, we want to create really great integrations. We want to create great guidelines. And mostly, to answer your question, we're looking mostly at partnering. We're always going to be open-minded about acquisitions, but we really want to elevate these partners around the world. And so we have some great partners today, and we really just want to be a great partner to them.
The reason I asked it that way, Brian, is strategically in the past, you've done some deals. I'm thinking like hotels tonight, or even areas you've divested from. What am I thinking of? Tickets, tour booking, right? But hotels is really interesting here. 20 markets for boutique hotels. I would look at that and say those are also markets where there are some limitations on short-term rental. But what's your pitch to the boutique hotel industry? Why Airbnb as a partner?
Well, actually, it's really interesting. They're pitching us, which I was very surprised by. And why are they pitching us? Well, because many of the boutique and independent hotels, by the way, if anyone's wondering how many there are, about 60% of the hotels in the world are boutiques and independents. Boutiques and independents don't get the same deal that chain hotels get, because chain hotels like Hilton and Marriott have points programs. They also are able to negotiate with Booking and Expedia lower commissions than boutiques. And so what we offer is a flat 15% commission on boutiques and hotels. We've got this great merchandising for them. A lot of boutique hotels, especially in Europe, love that we have American travelers, we have younger travelers, and we're just really built custom for them. And so they ultimately want more demand of young travelers in particular, and that's what we can offer them.
Changing consumer behavior, so hard. Or rather, bringing new behaviors from a consumer, so hard. I'm going to Paso Robles, right, in June. So if I book an Airbnb, okay, maybe it makes sense if I do the wine tasting experience with it. But with all the new things you have, how do you actually get people to make use of that?
It's really important that we personalize the app. So, some people want to participate and go do a cooking class or do a food tour on their vacation. Some people just want to relax and they want groceries delivered for them and they want everything taken care of. The most important thing is that we have a deeply personalized service. So with a new homepage, the app really learns about you. With AI, we can start to understand your preferences. But my vision is eventually every person they open Airbnb sees something different than something else based on what they love. And I, over time, want the app to feel like it knows you. We're in the hospitality business. Our app is only as good as the sense that it feels like it knows you and is personalized to you. So even if one day we offer 100 different categories of service experiences, we don't want to throw 100 things at you. We want to know the 5 things you really care about.
Since the beginning of May, I've been reading completely inconsistent reports about travel demand for the FIFA World Cup, particularly from the hotels. What is Airbnb seeing for those coming for this World Cup?
I mean, we are anticipating the World Cup will be the biggest event in Airbnb history. And we're seeing a similar travel pattern as the Milan Olympics. More than 60 days out for the Milan Olympics, it did not look like the demand was going to be what we anticipated. And then something unexpected happened. We had a surge of demand within 60 days of the beginning of the games, and 200,000 guests stayed in Milan and Cortina for the Olympics. So what we're seeing is people booking more last minute, but we are still seeing a huge amount of demand for the World Cup. So to answer your question, we are expecting it to be the biggest event in Airbnb history.
You spoke to my colleague and friend Natalie Leung about Chinese AI models and a misunderstanding of how that works in practice. But I just wanted to clarify, is Airbnb still using or relying on some of those models, Quen or even newer ones? And is that the open source opportunity, or is that the sort of cloud-based API where you're a customer of those companies?
We are not a customer of those companies. We're using a variety of different open source models. I just want to say a few things about this matter. Number one, data and privacy is most important to Airbnb. I think anyone who knows Airbnb knows we have an outstanding track record on data security and privacy. Number two, all of our data is vaulted. No company has access to our data. It is vaulted in Airbnb. Number three, the Congressional Committee has reached out to us. They said they have some questions. We said we want to cooperate, and so we're in direct contact and cooperation with them. And I think before I answer any more questions to the public, I want to make sure that the Congressional Committee hears from me directly.
Brian Chesky, Airbnb co-founder and CEO, expanding bag storage, car rentals, boutique hotels. But I love talking to you about technology as well.
Thank you.
Thank you very much.
Thank you very
Romain,
much.
back to you in New York.
All right, thanks, Ed. There, Airbnb shares, which you point out, up about 3% here on the day, part of a broader market rally. Isabel, we're seeing the S&P up 1%, the Russell 2000 up about 2%, but of course, all eyes are what's going on with the Philadelphia Semiconductor Index and the entire AI ecosystem, which of course, for the last 3 years has been led by Nvidia.
Definitely. I just can't wait for the results because everyone is expecting a beat and a race for Nvidia. But it is worth noting that for the past 3 quarters, after Nvidia reported solid results, it fell the next day.
Yeah, I was taking a look at that too, and the implied move today is basically about for a 5% move up or down, depending on how the results work out. But I went to look at sort of the betas of various stocks relative to Nvidia, and there are a lot more outsized moves that we've seen on those days from names like AMD and a Supermicro. We might actually see some of the power companies potentially move, depending on what Jensen Huang has to say. And my guess is the numbers themselves will be almost the sideshow. It's going to really be about that longer term outlook and forecast and how Jensen Huang sells it.
Exactly. I mean, it's really interesting. And overall, 93% of the chip makers had a beat this quarter. So definitely they're having a good time, Romain.
All right. Well, another stock having a good time is Cava. Those shares up about 3% after a phenomenal quarter. We're going to catch up with the CEO and co-founder, Bret Schulman, when we come back after the break, right here on The Close, right here on Bloomberg. 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romain Bostic. A focus today on earnings. Of course, everybody looking ahead to those earnings out of the world's largest company. But we got an interesting read on the health of the consumer and the health of one company, and that is Cava. Those shares rising today after the Mediterranean fast casual chain beat estimates on first quarter revenue and same-store sales, brushing off worries of a broader restaurant rut. I'm pleased to say joining us here in Studio 2 is the CEO, Bret Schulman. Great to see you, Bret.
Great to see you, Romain.
Same-store sales growth, phenomenal. Was at 9+% here. Revenue on the revenue side did well. What drove that?
Yeah, it was really what's been driving our business for the last 15 years and certainly have accelerated in this quarter is our differentiated Mediterranean cuisine, that unique cuisine where taste and health unite, delivered by our team members with exceptional hospitality, and that at a great reasonable value. You know, we're not going to be the lowest price, but we need to be a reasonable price and make it as accessible as possible for people to be able to share a meal with us. And that's something we've had a strategy for a number of years now where we've underpriced inflation, underpriced CPI by over 10%, and taken less than half the price increases of the average restaurant brand to be able to welcome more people to our table.
How much longer do you think you can do that? I mean, you've taken price. I mean, you've held, particularly on falafel and some of the other types of bowls, held price on that as well. But as you know, I mean, we don't necessarily know if the economy is changing, but the outlook right now by a lot of economists is that we could see greater price pressures on consumers. What does that mean for you?
Well, it means that we got to continue to reinvest in our team and reinvest in our guests. So a great example of that is, you know, we drove those same restaurant sales. Same restaurant sales growth helps drive leverage through our fixed costs on our P&L. But we didn't just pocket that margin expansion. We're taking that margin expansion and reinvesting in our guests, absorbing some of those potential inflationary pressures in the back half of the year. We talked about potential fuel surcharges on our transportation network and not pass those along to our guests. And we think that delivers long-term sustainable traffic growth over the long term, which will deliver healthy margins over the long haul.
I do want to talk about the menu itself. You introduced seafood to the menu, I believe, for the first time. We talked about this the last time you were here. It's out there. There's the pomegranate salmon, if you will. Talk a little bit about, the demand that you saw for it, but more importantly also the cost. And I know this came up on the conference call today, that at least on a cost basis for Cava, there's not really any additional profit coming from that, or did I have that wrong?
Well, it is 100 basis point margin rate headwind, but it's penny profit neutral to other items on our menu. So we tried to manage the costs that we can bring into our guests while still preserving the penny profit neutrality across our menu. So it is a profitable item for us, just a margin rate headwind.
Why pursue that if you don't think you can get a greater margin out of it?
Because we're not just in this to just take margin and charge the highest price to our guests. We want to bring high quality, relevant Mediterranean cuisine that's going to excite our guests, that's ultimately going to drive more frequency and more long-term traffic.
You are also introducing shrimp as well as some other items as well. Is that going to be a similar story with regards to the cost inputs?
Well, shrimp will be a lower price premium item. And that's something we've really worked to do, is create different pathways for our guests to join us at our table. So we did not take any menu price increase on our base Cava bowls and pitas, our chicken, our falafel, our roasted vegetables. So the same price of entry admission to the Cava table this year as it was last year. And then the 1.4% menu price increase that we did take was distributed across premium and attachment items. So if you want to join us and you want to trade up into a premium item like our grilled steak or our pomegranate glazed salmon, you have the optionality to do that as well. And I think that's also been helpful in kind of bridging this K-shaped economy, or split screen economy as some have called it, to really have consistent traffic and momentum across all markets, all regions, and all income strata. I mean, we noted on our earnings call that actually the lower half of the income strata was the strongest performing by median household income across our restaurants.
Oh, really? Wow. Yeah. I am curious about your expansion. You've already opened more than 70 restaurants this year alone. Does that pace continue based on what you know now?
Yeah, we actually increased our guidance by one additional restaurant from what we had initially set out to do. We have a really healthy real estate pipeline, and we're seeing record NRO, new restaurant opening volumes, across our fleet. So we just opened recently in Ohio, in Columbus and Cincinnati, in St. Louis. And again, we're seeing consistent, really warm receptivity to our Mediterranean cuisine when we open in these communities. So we want to make sure that we are able to bring it to other places across the country, but we want to also make sure that we've got role-ready, qualified general managers that are able to open those restaurants with operational integrity. So we feel like 75 to 77 is our current guidance that we're very confident in.
And with those new locations, you're confident you can kind of maintain the overall average unit volume as well as the margins that your older restaurants have had?
Yes, we've been doing, again, when we see that margin expansion from some of our traffic growth, we've been reinvesting. I talked about guests with menu pricing, but also reinvesting in our team, bringing new general managers on board earlier to have them trained longer, investing in our new assistant general manager position, which has already yielded better positive results in the restaurants that they are in, to provide better management complement across all what we call 14-day parts, 7 lunch, 7 dinner, so both nights and weekends. And then having trainers at those new restaurants for longer after we open to make sure that we get those restaurants open and stable before that they depart for the next opening.
One of the analysts on the conference call asked a question about catering. And I know you've done a test already, I believe, in the Houston market. Does this have the potential to be a bigger part of your business at some point in the future?
Yeah, absolutely. We see the demand. We've catered most professional sports teams, Major League Baseball teams, NBA teams, college sports, let alone office demand and schools. But we want to make sure that we set our operators up for success. This is a different production rhythm. It's highly concentrated volume. And we want to make sure that we don't distract from our existing channels with digital in restaurant. So we have our Houston market test. We're going to do a second market test later this year. And we're going to be patient and make sure that we have our what we call load balancing and capacity management of that demand against the production capacity we have in our restaurants appropriately.
Well, that's what I'm curious about. Would a catering business rely on, I guess, the existing footprint and the existing staffing that you have in the individual stores?
Well, one of the things we've been doing in recent years is building what we call hybrid kitchens or digital kitchens. So these are, some of them are regular Cava restaurants that have expanded back of house for centralized catering production to support the demand from the restaurants around it that may not have capacity given, we just crossed $3 million in average unit volume. So those restaurants are very busy, may not have capacity to produce catering. So we have these strategically located hubs to be able to support that demand.
You mentioned digital, the word. Obviously, AI is the big buzzword these days, and everybody wants to know how you're employing AI or whatever associated technologies, whether to improve efficiency, better track your customers. How are you using it?
Well, I talked about this in our shareholder letter the last couple of years. Very excited about the potential of data transformation over the next decade. Very similar to the impact that digital transformation had on our business the last 10 to 15 years. And one of the things we spoke to this quarter was the launch of our Cava Core data platform. And then building upon that foundation, kind of the foundation of the data house, we've built our Cava Current Commerce platform, which is ingesting all of our order flow in real time. And what all this allows us to do is, in the coming quarters and years, is build an intelligence layer on top of that to leverage generative AI tools and LLMs on top of a clean source of data that is ingesting all the real-time activity in our business to do a few things. One, create operational efficiencies and take a lot of complexity off of our team members' plate, out of their mind share, like predictive cook, predictive prep, inventory management, labor scheduling, to free them up to have that human connection and deliver that Mediterranean hospitality. It also allows us to have very personalized engagement with our guests, to really understand their behaviors and preferences and make their experiences richer and more beneficial to them, and ultimately create better value for the business. And then lastly, on the business intelligence side, we're already seeing productivity gains with our enterprise LLM tool that is able to automate a lot of the analysis that used to take hours or days of work, whether using spreadsheet tools like Excel or Hyperion, and automating that, again, making our team members more productive, more powerful. We like to say how we think about it is technology to enhance the human experience, not replace it. And very excited about the early returns, and I think we're just in the early stages of this journey over the next decade.
All right, Bret, I have to leave it there. Great quarter. Hope to have you back soon for the next one. Cava CEO there, Bret Schulman. All right, when we come back, we're going to talk about another potential earnings report coming after the bell tonight, and that's out of Intuit. We've already got some insights maybe into what we could hear from them with regards to their staffing. That's our stock of the hour, and it's coming up next here on The Close on Bloomberg.
Time now for a stock of the hour. Shares of Intuit declining ahead of the software company's quarterly report due after the bell today. There's also a Reuters report out today claiming Intuit plans to cut around 17% of the staff in an efficiency push. Bloomberg TV Markets correspondent Nora Melinda joins us with the latest. So, Nora, usually the stock responds positively with job cuts. Why do you think it's reacting like this?
No, this is an interesting one because, to your point, Wall Street tends to actually celebrate when we see companies cutting off some of the headcount here. But I think the broader discussion right now is about artificial intelligence and whether or not some of these companies are using the idea of slashing their workforce as a way to hide what's going on underneath, potentially regarding margins. And so you're seeing essentially customers, you're seeing investors really grappling with this idea as to whether or not Intuit's going to be able to keep up with some of its competitors and actually deliver on the artificial intelligence investment that it's really putting a lot of its energy into right now.
Well, I am curious about that. I mean, and everyone knows, I mean, if you used any of their products, like QuickBooks and TurboTax, and if you've also sort of then overlaid that and tried to do some of that stuff in ChatGPT or Claude, you can certainly see the potential for that to catch up.
Right.
Are investors getting ahead of themselves? Because this stock has gotten beaten up all year long.
Oh, yeah.
And I am curious because I'm looking at analyst estimates for revenue. Most analysts still have modeled in double-digit revenue growth for pretty much every quarter going out for the next couple of years here. So what am I missing?
So this company is not alone in terms of the performance. If you take a look at the performances, you're down 42%, so pretty substantially. But you look at peers, Workday, looking at Salesforce, also keeping an eye on Autodesk, all of those also largely lower. So you are seeing a bit of a bifurcation, a divergence between some of those software names. You're seeing the market really favoring some of the actual AI enablers like chip companies. But software, they're a little bit iffy about as they think about whether or not all the money that they're actually putting into artificial intelligence will actually come to some sort of concrete positive outcome here.
Just point out, analysts are expecting record
it's
revenue
insane.
this quarter, $8.5 billion. And it's not to say that AI doesn't disrupt them, Isabel, at some point.
Right.
But at least in the here and now, it's not showing up in the numbers, or maybe it does tonight.
And it's not just Intuit. We also saw Meta cutting around 8,000 jobs. I mean, I have friends who work there and they're bracing themselves. It's really a week of layoffs.
Absolutely. I mean, we're seeing obviously cost cuts can boost profitability, but people are just trying to figure out whether or not this is a strategic move or more of a defensive one, and that's what you're seeing the market grappling with today.
Absolutely. Intuit set to report earnings after the bell tonight. It might get overshadowed just a bit here, but the shares moving lower as we move closer to that earnings report, with analysts expecting 10% revenue growth to a record $8.5 billion. Nora Melinda, our markets correspondent there. Meanwhile, Isabel, we turn our attention, as we do, back to Nvidia. The countdown to the close and the countdown to those earnings just up ahead. And it's hard to understate just how high expectations are right now.
Definitely hard. I mean, Nvidia, it's still the biggest stock in the market. It comprises 1/5 of the S&P's rise this year. I feel like it's kind of overshadowed with the war and everything, but still, all eyes will be there.
A conversation up ahead with Nguyen over at Research Affiliates. Stick with us. This is The Close.
The real question is, when are we going to get a handle on how much some of this is going to cost? So let's just take one example. Meta's Louisiana data center project, they started by telling the world it was going to cost $10 billion. Now it's up to $27 billion, and I've seen published reports that say it could go up to $200 billion. That all may be a perfectly wise investment on Meta's part, but until you can get a handle on where it's going to stop, it's hard to know what the returns are going to look like.
Ted Smith, the co-founder of Union Square Advisors, yesterday talking about, of course, the AI boom and, more importantly, the money needed to finance it. A lot of worries right now. No one's saying that this AI boom is indeed going to necessarily pop, but when you talk about what needs to be funded, the question is, where does that money come from and what's the cost?
That is true, and I feel like today, of course, the center is Nvidia, but if you take a step back, it's been a great quarter for chip makers. I think some 93% of them beat and had double-digit rallies a day after they reported earnings. It's really quite a stellar rise for all of them, and I feel like this earnings season, we've seen a lot of blowout from Intel, AMD, and all of those, and it's really been spectacular to witness.
Chip stocks as a group on fire today. The Philadelphia Semiconductor Index up about 4%. That's helping to lift the S&P by 1%. The NASDAQ up 1.5%. The Russell right now up about 2%. And that yield story that we have been talking about the last few days, a bit of a reprieve with long-term yields. The 30-year yield down about 7 basis points. Let's bring Nguyen into the conversation. She's CIO of equities over at Research Affiliates. All right, Quay, no one's really quibbling over what amount of money Nvidia is going to make in the most recent quarter. I think what people are quibbling over right now is how much further this AI build-out goes, how much it's going to cost to actually fund this, particularly in light of the fact that when this all started, interest rates were a lot lower than where they are today.
Yeah, I think you're right. The interest rate story could really put a dent into this whole AI capex cycle, and that could be very problematic. But having said that, the hyperscalers, the Microsofts, the Metas, the Alphabets of the world, these are companies with very strong cash flow, very defensible businesses, and so they're financing it from a combination of cash flow and debt. So it could go on for a bit longer, even with the higher interest rates.
I am curious about this idea, and I know you've written about this this potential for obsolescence, the idea that we're building data centers and other infrastructure, that given the pace of this technology, by the time a lot of that stuff actually comes to fruition, we'll be on to the next big thing, which who knows what that is. And I do wonder how that gets factored in to the cost of capital, or more importantly, I guess, the risk in taking on debt where the duration may end up being longer on the debt than it is on the actual thing that's being financed.
No, I think you're absolutely right. I mean, I think that there's a lot of games being played in terms of the real economics behind this. Having said that, I do think that in any great leap forward, any innovative leap forward, there's always going to be a speculative bubble. And lots of money gets invested, lots of money gets spent. And what's really interesting about these speculative bubbles is that the long-term benefits don't always accrue to those who spend the most in the early part.
And you said that rather than buying obvious names like Nvidia, which is obviously the stock we've been talking about for the past hour, you want stocks that are 1 or 2 degrees removed. What do you think the market is mispricing in this AI boom?
I think right now it's, everybody is attaching kind of like a brand premium almost to Nvidia. But Nvidia doesn't produce nearly enough chips to fuel all of the investments, and you're going to need a whole bunch of other things that benefit as well. So, whether it's equipment, semiconductor equipment companies, I think are an area that can be overlooked. I also think that just simple memory devices can be overlooked. So there's a lot of opportunities in technology. We've seen a boom very broadly over the past 6 months, and we've been in a position where we've constantly needed to trim these positions that we've been in.
I did notice that you're balancing your tech exposure with some defensives like healthcare and even staples. Is that a sign you're preparing for a slowdown or some more volatility ahead?
It's a sign of we just want to have a balanced portfolio. I mean, if you really want to be diversified, right, you can't just put everything, you can't just bet on red. And so what we're finding is we're finding reasonable valuations with strong cash flow in these sectors.
I am curious about this idea, particularly given kind of what is the crux of what you do at Research Affiliates, how you value some of these companies in the AI ecosystem. Because, I mean, anybody who looks at the traditional multiples now on some of these companies, I don't know if there's a historical precedent to really say whether that's fair value or not, given the promise, potentially, of what AI can bring. So how do you approach that from an analytical, quantitative way?
Well, obviously, one of the things we're looking at is we're just looking at what has been realized in terms of not just cash flow, but also growth, right? Because there is this promise of accelerating cash flow, accelerating sales, but have these companies actually been able to deliver on it? Mm-hmm. So you do find some companies that are being priced for perfection, but their sales or their profitability just really hasn't been there.
And it's funny, we were talking a little bit internally here about some of the dot-com boom and bust, and I was kind of going back and looking at some of the biggest public equity performers back in 98, 99, before the bubble happened, with the exception of, I think, Qualcomm, and there was one other company that I'm forgetting. Oh, it was actually ARM, which was their London shares at the time. Almost everybody in that top 10, 15 list basically doesn't exist. They either went out of business or got absorbed in some way or another by another company.
See, that's another example of the biggest and earliest investors don't always end up being the winners, right? I mean, I think that from that era, if you look at who the big winner of that whole cycle was, it was actually Apple.
Yeah.
And Apple was nowhere in terms of investing in the internet.
Do you want to know one of the worst performers that year? Amazon. Yeah, and look at them. I mean, obviously at the time they weren't a tech company.
Eventually,
but
over
they've turned
time.
into one. But I was looking at the names. It was like Broadvision and InfoSpace and Emulex, and names that I think most people probably don't even remember.
I want to go back to hyperscalers because you said that they can handle higher rates because they generate a lot of cash flow. But does that make investors a little too complacent about their valuations, you think, or?
Well, some of these hyperscalers aren't that expensive. I mean, take a look at Microsoft's valuation right now. It's really not that bad. I mean, that's actually one of the names that we've been nibbling on over the last 6 months. Another example is Alphabet. Now, we're out of that name, but earlier last year, I mean, it was valued at roughly what the S&P was being valued at. And so investors are looking at that. They're looking at these massive cash flowing companies turning into more investment-heavy companies, right? But having said that, they still have these very, very defensible businesses.
Quay, always a pleasure. Quay Nguyen, CIO of Equities over at Research Affiliates, counting us down to the closing bells. And of course, we talk about some of those big names, the Microsofts, Alphabets of the world. Pretty much that entire ecosystem of big tech right now is in the green. Of course, this is after about a 3-day sort of pullback in some of those names, largely because of that rise in interest rates. But it seems like there's a lot of optimism around what we might hear in just about 20 minutes or so.
A lot of optimism, and overall, the earnings for the season has just been spectacular. 90% have been beats. First quarter EPS growth is averaging 26% year over year. That's the highest rate, Romaine, since 2021.
Yeah, and not to just to put a finer point on this too, when it comes to the estimates for Nvidia, we're talking about a company that analysts expect to post roughly about 80% revenue growth in the most recent quarter, more than 80% profit growth in the most recent quarter, and free cash flow approaching $100 billion on a 12-month rolling basis.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Isabel Lee, filling in for Katie Greifeld. We're taking you through to that closing bell with the global simulcast. Tim Stenovic joins us from the radio booth, joined today by Emily Crofeo, in for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, as we prepare for what is going to dominate the rest of the afternoon, Tim Stenovic. And that, of course, are those earnings from Nvidia.
Okay, I was hoping you were going there.
Yeah.
Yeah, I didn't know. I thought you were going to maybe throw a curveball at me. Yeah, I'm watching Nvidia ahead of this. Shares up right now by 1.2%. Questions remain about competition from some new entrants and even the way that some hyperscalers are, able to train and use inference. So a lot of questions about this, and it will really set the tone for the AI trade starting in just about 20 minutes.
And I think also analysts watching here, not just for an Nvidia beat, but the scale of how this company can beat expectations. For the last many quarters now, the earnings have come out and it's been pretty much a beat across the board.
And to Emily's point, I mean, the growth outlook, it's still strong, but it's expected to decelerate in the coming years, and that could further impede on the stock price. I hate to be the party pooper, but I don't think that something can just go up, up, up. Or who knows, maybe it can.
Yeah, well, it's been going up, up, up for about 3 years here, so we'll see whether anything changes that calculus tonight. I do just want to point out there's a lot more moving today besides just the chip stocks and Nvidia, but, well, let's face it, not a whole lot else. You are seeing a big bump in some of the airline names like United and Delta, as well as the cruise lines as well. But of course, this is going to be a day where big tech dominates the afternoon when we get those earnings from Jensen Huang and his team in just about 20 minutes. The closing bell is now ringing here in New York. An update here after what was effectively 3 days of market malaise. With yields down, stocks are up. The Dow adding more than 600 points or 1.3%. The S&P higher by about 79 points or 1%. The NASDAQ up about 1.5%, Tim, and the Russell 2000 closing out the day higher by 2.6%.
Well, it is not just Nvidia that's reporting results. We're also getting some results from Intuit. Remember this company announcing that it's cutting 17% of jobs to focus on AI. But some other numbers that we are getting, third quarter net revenue coming in at $8.56 billion. Intuit, as far as the outlook goes, sees fourth quarter adjusted earnings per share $3.56 to $3.62. That's above estimates of $3.15. It did raise its fiscal year revenue guidance. Shares in the after hours bouncing around a little bit, up as much as 5%, now up about 4% in the after hours.
Yeah, this kind of vexed me a little bit, some of the concerns that we saw earlier in the cash session. And we had Nora Malindo on, and I was kind of asking her, I mean, you have analysts projecting, coming into this print, projecting record quarterly revenue of more than $8 billion. They got that. And when you look at on your Bloomberg terminal what those estimates are going out for the next 4, 6, 8 quarters, it's all double-digit revenue growth as well as increases in profitability. So if there is sort of some sort of I guess killing of the software space because of AI, at least for right now, it hasn't shown up on the radar of a lot of folks.
Yeah, that's a good point. Third quarter adjusted EPS, we're also getting that number now, $12.80. That's above estimates of $12.54. Shares in the after hours down about 3%. Hey, we are focused, of course, on Nvidia and the broader markets as well, in addition to Intuit. In the S&P 500, it was relatively broad-based today, Isabel. 349 stocks higher in the S&P, 152 lower.
I know, if you look at the IMAP, it's mostly green on the screen. Biggest gainers, of course, undoubtedly. We have tech higher by 1.5%, financials by 0.8%, consumer discretionary also in the green. And unsurprisingly, the biggest loser is energy. We are seeing a slide in oil prices on hopes for a deal to end the war in Iran. You're seeing that lower by nearly 1%.
All right, well, let's get to some of the gainers in today's session. Again, all eyes on Nvidia. Worth checking in on how that stock did today, up 1.3%. Remember, we are kind of just a couple weeks ago watching $6 trillion as the market cap for this company, up now up this year, just about 20% going into today's print, the market value of about $5.4 trillion. As far as numbers go, revenue estimate for the first quarter, $79.15 billion. The revenue estimate for the second quarter, analysts see $87.2 billion, and for the year see $370.8 billion. So some of the numbers to keep in mind ahead of that print. Adjusted gross margin estimate to the tune of 75% for the second quarter, and adjusted operating expense estimate $7.67 billion. Just a few numbers ahead of that print in just about 17 minutes. Also questions I think a lot of consumers and a lot of analysts and investors have when it comes to competition, especially with the tune of Broadcom, AMD, Google, and more. So keep an ear out on the call for any questions about that. And speaking of AI, let's talk a little bit about some power and utility stocks moving in today's session. To the upside, utility stocks climbing after PJM interconnection accelerated plans to pair data centers with energy producers to feed the demands of AI development. You got Constellation higher today by 7.9%. You've got Vistra Corp up by 6.9%. The PJM changes are now expected to help power producers secure additional data center contracts and reduce the risk of prolonged uncertainty heading into 2027. And a little retail on this Wednesday afternoon. TJX Co's, the parent company of TJ Maxx and Marshalls, higher in today's session by 5.7%. The company raised its sales growth expectations for the year. Cautious shoppers are spending on lower priced goods at the company's discount chains, Emily.
A little retail, maybe a lot of retail, because I also have a retail stock for my first decliner. Target shares falling about 4% today. The company's earnings results, honestly, not that bad. However, the retailer did warn investors after striking a more cautious tone about the coming months. So comp sales jumped 5.6% last quarter. It was the biggest increase since the end of 2021 and actually triple the gain analysts were expecting. However, executives warned on the earnings call that there are tougher comps in the current quarter, more cost challenges ahead, and the benefit of tax refunds on its business are also fading. So that stock down, again, closing about 4% lower. Another decliner on this Wednesday, Hasbro. The guidance disappointing in this earnings result coming out today. That stock down about 8%. The company maintained a sales forecast for the year that was on the low end of what analysts expected. The toy maker, home to G.I. Joe action figures and the playing cards Magic the Gathering. I don't play either of these games. I'm not sure if you do, Tim. They reported that sales in the first quarter.
I know Romaine does.
Yeah, I feel like Romaine's a big.
Oh yeah, I'm big into that.
Okay,
D&D.
got it. They reported sales in the first quarter rose 13% to $1 billion. Revenue for the company's games unit rose 26%, but was flat in traditional toys and declined in its entertainment business. Finally, one chip stock, of course, we're all watching Nvidia, but there was one chip stock that already reported, Analog Devices. They actually reported second quarter results that beat expectations and gave an outlook that some actually saw as strong, but we are seeing that stock lower by about 4%. It was up about 50% year to date heading into the earnings report, so it could have been a little case of the bar just being very high for that report.
I just want to go back and just flag too. Intuit shares now down about 10% in the after hours trade. If that carries over into the cash session tomorrow, that'll be the biggest one-day drop post earnings day going back to 2015. Meanwhile, we are getting some earnings out of Elf Beauty. Those shares are moving to the upside, at least for the knee-jerk reaction here, with the company saying that its fourth quarter adjusted EPS did beat by about 2 cents. 32 cents is the number. Net sales at about $449 million. That came in above estimates as well. And the company says that for the full year, here's what to expect. The guidance, net sales, a range, 1.84 to 1.87 billion. The high end of that range is just above the average of analyst estimates of 1.86. Your EBITDA forecast adjusted, of course, $379 to $385 million. Now, we should point out that is light. The top end of that range is below the average of analyst estimates of $3.87 million. All
right, so more retail. You've got Elf. I'm looking over at Urban Outfitters. We're seeing the stock move in the after hours. Right now, Urban Outfitters' first quarter comp retail segment sales are up by 5.6%. Still waiting for some of these numbers to cross. Shares higher by about half a percentage point. Urban Outfitters' first quarter net sales coming in just above estimates at $1.48 billion. Once again, shares of Urban Outfitters higher by just about half a percentage point. That is going to do it for our cross-platform coverage of the market close. The closing bell on this Nvidia Wednesday. I know you guys are going to keep covering all things Nvidia when those numbers do cross in just about 12 minutes. In the meantime, we will see you same time, same place tomorrow.
And stick with us here on The Close as the clock ticks down to those results from Nvidia. We'll be back in a moment. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. The three-day malaise that we had seen in U.S. equities ended today in a big way, with the S&P 500 up 1%, led largely by, well, what else? chip names. The Philadelphia Semiconductor Index rallying about 4.5%. Even software stocks got in on the action. A big part of the reason, of course, is this big drop that you saw in the 30-year yield, down about 7 basis points after that phenomenal 50 basis point rally over the last few days and weeks. Now, we are going to talk a lot about Nvidia and the chip space here from every perspective here. The entire ecosystem of what's been going on with AI. That includes ARM Holdings, which had a 15% jump today. It includes Constellation Energy, which had an 8% jump today. It includes Microsoft, which added about 0.9%. And, well, it also includes Intuit. Some concerns here about some of those software names and whether they, once the disruptors, might actually now start to be disrupted themselves. And that does bring us to our top story of the hour, Nvidia, the largest company by market value and the most phenomenal growth story in a quarter century. Revenue, which had stagnated just 4 years ago amid waning demand from its once core consumers of those computer gamers, it's found new life in this AI buildout. Revenue doubled in 2024 fiscal year. It then doubled again in fiscal 2025. Growth slowed a little bit in fiscal 2026 to just a mere 65%. And now, Nvidia is minutes away from reporting for the first quarter of fiscal 2027, where analysts expect revenue growth to have re-accelerated to 80%. In fact, Nvidia's compound annual revenue growth rate over the past 3 years is 14 times the average for the S&P 500 as a whole and 7 times the average for the NASDAQ 100. And free cash flow, which 4 years ago was less than $4 billion, has now likely surpassed $100 billion on a 12-month rolling basis. And that's where we start, where that money is going, from Nvidia suppliers to its investments in other AI ventures to the end use cases for AI products and services. Our first guest this hour through her VC fund has helped bankroll the application and infrastructure layers of this AI chip boom. Think Mistral, Modal, LiveKit, Inferact, as well as Poolside. It's quite an impressive list of names. Erica Brescia joins us right now, Managing Director over at Redpoint Ventures. Erica, great to have you here. Let's first start off with this big CapEx spend that we've seen in this AI space and sort of the hub, to a certain extent, that Nvidia has been for this flywheel out into what is now a really rapidly growing AI ecosystem. What are you expecting tonight?
Yeah, it's an incredibly exciting time in the market, and I think we look at Nvidia as a proxy for what's happening in AI broadly. I will say, I think investor expectations are incredibly high. This company has obviously been doing well, as you highlighted, for years. And if they don't beat and increase their projections, I think we might see a little disappointment in the market, despite the fact that it's an incredible company. And it's important to ground ourselves in how much they've grown and what a critical role they're going to play over the next few years as AI permeates into the enterprise.
Well, that's what I'm curious about, and maybe you can give us some insights, particularly given where you're at now, where you were at before with GitHub and your long career in the tech space. I mean, what is the adoption looking like? And I don't mean just from, the tech faithful, but for more normal people, normal companies. Is that adoption rate at a pace that you think is going to sustain the amount of spending and investment that we've seen in AI?
I think it's going to accelerate. Look, I think AI coding is obviously the runaway success here, and we've seen that in Anthropic's just unprecedented revenue growth. And we're seeing that across the board at companies that are very progressive and even some that historically have been slower to adopt. But when you take a step back and you look at all the different ways that AI is going to impact the way that enterprises do business, it's really day zero. People are using co-pilots and things like Microsoft and Google products, but we haven't really scratched the surface of true agentic work in the enterprise. I think that will take years to unfold. And I do think we'll see an acceleration from where we are, which is really day zero on that front over the coming years. And that will propagate throughout all of the infrastructure pieces of the AI stack.
I'm sure you've heard some of the naysayers, some of the people who, quite frankly, are maybe just being prudent and cautious. The idea that maybe the spending is outpacing the adoption, that spending is not really showing a return on investment for some of those people that have put a lot of money into this. Is there credence to that?
There is, but it's part of every adoption cycle. The first thing that companies are doing is experimenting. And I'd say the smart companies are experimenting more, right? They're giving people the tools, they're giving them access to different models. They're encouraging people outside of software developers to embrace AI, to find ways that they can improve and automate their work with it. And that's going to result in a lot of unnecessary spend and waste, but it's part of driving the cultural change that these enterprises are going to need to make happen in order to remain competitive over time. So I think we're just in a period of experimentation, and the tools are still coming together at the infra and the security layers to actually enable, you know, more mature and widespread deployment in the enterprise. And I think we'll see some more efficiency gains as well as like productive use of AI spend as people understand how to put AI to work in their organizations.
I am curious about, you know, and gets a little bit nebulous here, this idea of the backlash. There's been a lot of hay made out about the potential for job losses. There's been a lot of jokes made about some recent commencement speeches that really focused on AI and that did not necessarily land well with those graduating seniors. And I do wonder if that, to a certain extent, I guess the idea of consumer sentiment or public sentiment becomes a potential threat to the growth rate that we've seen so far.
Look, the unknown is scary, and I'm a parent to a 13-year-old, so I think about what the future job market is going to look like for him as well. But AI is, you know, not something you put back in Pandora's box, and I think it's going to bring incredible productivity and new opportunities to the world. We don't have all the answers, just like we didn't during the Industrial Revolution, just like we didn't, you know, have the advent of the internet. And yet, look at where we are. Look how much society has improved, and look at all of the medical and other advancements to come. You know, we're making incredible progress on things like cancer and Alzheimer's. And again, it's the early days. So, you know, I'm not surprised that there's some fear because there's a lot of uncertainty. And any time that there's change, it's frightening for people. But I think over time, as we understand how to put AI to work, there'll be a whole new class of jobs, and we'll have companies that are much, much more efficient, and probably more companies because it's easier to build and start things than ever before. And so, yes, I think there's cause for concern in the short term as we digest this pretty monumental change as a society. But the future, if you look out a little bit further, is very bright. And this is just going to be a, you know, temporary period of digestion as we make this incredible shift in how our society works.
We are about 2 minutes away from those earnings out of Nvidia. And Erica, I do want to get your thoughts from what's been going on in kind of the private side and what sort of lessons publicly traded investors can sort of take from this. I mean, you obviously helped to lead that seed round in poolside, and there's been a lot of talk here about some of these coding tools, whether they become complementary to what we already have out there already, or whether they become a threat to what's already there out there. I mean, what do you think public market investors should know and taking a lesson from what you're seeing in the private space?
I think the way companies operate are going to change. And we've seen that in this spate of layoff announcements and AI-related announcements across both public and private companies. In the public markets, what I'd be looking for is leaders who are really leaning into AI and understanding how to reinvent every aspect of how they operate, not just their products. How does finance work? How does customer support work? You know, obviously, how does engineering work, et cetera? But I think the companies that are going to survive this shift well are the ones who are very forward-thinking and proactive in looking at how to embrace AI to make their businesses more efficient, to drive growth, and to potentially expand their product footprints.
All right, hold that thought for 1 second. In conversation with Erica Brescia, Managing Director over at Redpoint Ventures, as we await these earnings out of Nvidia. We've talked a lot about the estimates, but I'll just reiterate them once again. Revenue is projected to come in around $79 to $80 billion. That's almost an 80% growth rate. Almost all of that coming from their data center revenue, roughly about $73.5 billion. Adjusted gross margin expected to come in at about 75%. Operating expenses at $7.19 billion, and adjusted EPS, that bottom line number, the street right now looking on average for about 1.8 0.78 there on the nose. And this, of course, becomes a story because of everything that Nvidia touches and how it goes, maybe goes the rest of the market. Those numbers now crossing the wire, and it looks like a beat on the bottom line. First quarter adjusted EPS coming in at $1.87 here. Remember, this is their fiscal first quarter that just ended in April. Their fiscal first quarter revenue, $81.62 billion, above the street estimates of 79.19, adjusted gross margin of 75%. Here's your second quarter forecast. The company says look for revenue of $89.1 billion for the fiscal second quarter. A range of $89.18 to $92.82 billion. The street on average was looking for 87.36. The company said adjusted gross margins for the second quarter should expand to 74.5 to 75.5 billion, 75.5%, excuse me. And the company also saying, just take another quick look here, that operating expenses for the quarter that we're in right now, should come in at about $8.3 billion. The street was looking for about $7.93 billion here. So basically a beat on the top and the bottom line. Guidance slightly higher than what the street was looking for the current quarter. The company also saying that it is adding about $80 billion to its share buyback authorization as well, and boosting its quarterly dividend to about 25 cents a share from 1 cent a share, if you will, here. The share is fluctuating between gains and losses. I want to go to Matt Bryson right now. He's Managing Director of Equity Research over at Wedbush Securities. All right, Matt, these numbers relatively in line with estimates. The guidance slightly higher than what the street was looking for. What was your first reaction?
I think it was exactly like last quarter and the quarter before. I'm looking at their guide, Romain. I'm seeing slightly better numbers than you just stated. 91 billion for Q2, gross margins at 75%. I think that the bogey from the buy side was around 90 billion. So I think they hit the buy side expectation. They certainly beat consensus. So I mean, once again, I think they delivered on what people wanted. It's just, as we've seen lately, the stock doesn't always do what you expect it to do on them hitting that number.
Yeah, and we should point out, I mean, the last three earnings periods where they did beat to the upside, we saw the shares fall the next day in trading, so maybe we get a repeat of that. But I am curious, Matt, about what you expect to hear from Jensen Huang on the call, because obviously a lot of what's fueled this stock's rise isn't just what happened in the 3 months past or even what's going to happen in the next 3 months, but Jensen Huang's long-term vision and how he articulates it.
Yeah, no, I think we're going to hear a lot of what we heard at GTC. So that they're executing on Ruben Vera, they're executing on Ruben. That Feynman is coming not too far away. That they're pushing the boundary of what we can do with AI, and similar to what we got from Google earlier this week. I think they'll talk about these inference workloads that are just exploding. And that just demands a whole lot more in terms of accelerators, compute, networking. So right in NVIDIA's wheelhouse.
Well, it gets to this idea, too, and we heard from Jensen Huang alongside Michael Dell earlier this week on Bloomberg Television, kind of talking about sort of the yin and yang between the CPUs and GPUs and the sort of move from where we were in the AI LLM space to now inference here. And the picture that he's painting is the idea that this is all complementary, and at the end of the day, you're still going to need the high-end NVIDIA chips in one form or another to continue doing the next phase of this cycle. You buy that?
I think that's exactly right. I mean, you're never going to get away from training, which is where they've been leading so far. We still have to see how that Grok piece works out. But regardless, you're going to need accelerators. And if you look at the size of the accelerator market versus the size of the compute market, obviously accelerators are a whole lot bigger. But then if you think about growth even, with inference taking off, you still have accelerators growing at a faster rate than we do compute. So I don't see growth for accelerators declining at all. I mean, it does look like there's a whole lot more demand for compute, but that's not a bad thing for NVIDIA.
Yeah, sit tight for 1 second, Matt. I do want to bring Erica Brescia back into the conversation over at Redpoint Ventures. And now that you've had a few minutes here, Erica, to digest the numbers that we saw, I do want to just get your initial thoughts here, not only on what it means in the here and now, but whether it gives you a signal here that what's been baked into this market is indeed sustainable.
I definitely think it's sustainable. And look, another amazing quarter. I think our expectations for this company just keep leveling up quarter over quarter over quarter. And so we are kind of pushing them on that front. But to the Vera Rubin point earlier, there's a lot of exciting stuff to come here. And I think one thing that perhaps not all public market investors are following is this move to agents is really consequential for AI and for Nvidia and the broader industry, right? The amount of inference and compute that we're going to need to run the agents to execute on all this agentic work for us to help us build these more efficient companies, like that's still coming. And I think Vera Rubin was built very intentionally to support those types of workloads, which should be 10x or 100x, maybe even 1,000x the inference workloads that we're seeing today. So I'm still very bullish on Nvidia and how they continue to navigate, like not where we are today, but where the industry is going and what types of chips and architectures that we're going to need in order to power all of that compute.
Erica, appreciate it. Erica Brescia, Managing Director over at Redpoint Ventures, as we continue to watch shares of Nvidia fluctuate between gains and losses. Matt Bryson still with us over at Wedbush. And Matt, I do just want to point out a few other headlines that came across the wire. As expected, no revenue, no shipments, I should say, from those Hopper products to China in the quarter. That was expected. The company also says, though, it's going to change its reporting structure here to focus a little bit more on data centers and edge computing so that we have a better sort of sense of exactly where they're making money. The company also says hyperscale revenue is at about right now 50% of its data revenue, and that its Vera Rubin is on track for the second half of the year. Your thoughts?
Yeah, I mean, I think that sums it up exactly. If you think about where the revenue's coming from today, it's mostly data center. Having said that, I think breaking it out is important, as you've got these new areas like physical AI, which probably fit at that edge side. It would be good to get some insight there. And the only other thing that I'd add after picking through their commentary is they now have 120 billion in supply commitments. I think right now that one of the hardest things is just getting enough components out there. There's not enough memory. There's not enough compute. There's not enough substrate. And I think Nvidia is doing a better job of it than anyone else. And the sheer amount of commitments that they've made kind of talks to that.
I am curious, though, about the edge computing side of this and the decision to actually report that out. I mean, we're talking a very small portion of their business right now. I think about $6 billion in the most recent quarter, so basically less than 10%. What does that say that they feel like they want to break that out going forward? Is this where we should be looking for more growth?
I think certainly that's where you eventually get growth, right? It's not just within the data center and running applications within the data center. It's once you start delivering value in terms of autonomous driving, in terms of robots building things in factories. So I think it's important to watch that segment, because there is a ton of value to be delivered there. Mm-hmm. And I think getting more insight into that, right? More numbers is always a good thing.
Absolutely. Matt, really appreciate it. We'll let you get back to it. Matt Bryson there, Managing Director of Equity Research covering hardware over at Wedbush Securities. And a reminder, we are expected to hear from Jensen Huang and his team at the top of the hour on their conference call post-earnings. Earnings that did come in slightly above estimates for the most recent quarter, their fiscal first quarter. And the guidance they gave for the second quarter, slightly above analysts' estimates. The shares have been oscillating between gains and losses, now up about 0.9%. Of 1%. John Belton joins us right now. He's a portfolio manager over at Gabelli Funds, and Nvidia is one of his top holdings in his growth funds and growth ETFs. All right, John, what were your initial thoughts when you saw these numbers?
Yeah, thanks, Romain. I mean, very good, I guess, as expected. I think the most interesting thing we've learned so far is just this these plans to resegment, basically, and reclassify some of the revenues going forward. Still haven't had a ton of time to think through that, but that's kind of the most unexpected thing so far. The numbers themselves, I think, definitely touch better than expectations in the quarter. right around where expectations were on the guide. Margins were solid, so I think all that seems to check out as they kind of always do.
I know you haven't had a lot of time to think about it, but I do want to ask you, because I know the edge thing really jumped out at me here, because to break out something that is such a tiny part of your business now seems to be a signal to the market that this is where the puck is going. And I think we've all kind of known that, right? We've kind of gotten past the phase of just using chatbots to, plan our vacations and things like that, and that the broader use cases are going to start to come to the real market sometime soon. And I am curious that, as somebody who is deeply invested in this space, not just in Nvidia, but in the broader tech space here, I mean, how do you see this evolving longer term, whether it's with whatever the new device will be that consumers will carry around, whether what we see in the industrial space, whether it's autonomous driving? Where are you looking to?
Well, I agree with you. I have the same kind of hunch as you do, that they're obviously doing this for a reason. I do think, this is a small part of the business. Presumably, this will be the faster growing part of the business. And I think there's kind of two buckets to think about this through. One, there's new applications for edge products, and then there's new products. And so I think on the new applications, we already know they're in areas like autonomous driving, like earlier use cases, robotics for AI that are poised to grow really fast over the years to come. But on the new product side, I wonder if maybe some of the forthcoming standalone Vera racks will be reported here, and maybe we can start to see or get a sense for how fast NVIDIA's CPU business is about to start growing, and maybe that has implications for the rest of the space. So more so thinking out loud, because it's still so early. I've just had 2 minutes to look at this, but that's kind of the first thing that I thought of when I saw this.
Yeah, we tend to do that to guests, John, here. I mean, we only give you a couple of minutes to think about things. I am curious, though, too. We talk about a company that is also going to get a lot more competition going forward. I mean, it's kind of had this market, for the high-end chips at least, to itself. AMD is obviously trying to do what it can do. There was obviously this whatever's going on behind the doors over at Alphabet and Google here. With the potential introduction of higher-end chips that can maybe do, or at least do close enough to what NVIDIA can do, do you see that potentially as a threat, or is the addressable market going to be big enough for everybody?
Yeah, there's so many different things to talk about under this umbrella, but I think within the accelerator space specifically, and specifically for let's break it down by workload type within AI. So I think for training, NVIDIA clearly dominates the market. I think that is very likely to continue. I don't see a ton of promise for competition in that area specifically. I think there's always going to be a place for custom. And then maybe there's going to be certain players that also want kind of a second merchant option, which is AMD. Now, for inference, I think that's where the conversation's getting a little bit more complicated. I think the inference market seems to be bifurcating between different types of inference workloads, some of which are really well suited for NVIDIA's products, some of which are less well suited for NVIDIA's products. One thing they did in that area to address some of those workloads is the Grok acquisition last year. We're going to hear them talk about that on the call today. I think that's going to be very important to monitor.
Yeah, and I am curious too about, and that's a good point. I am curious too also about just the cash juggernaut that it is. Free cash flow in the most recent quarter, roughly about $49 billion. The company announcing a new buyback program, raising its dividends here. Are we going to see, do you think potentially we are going to see a little bit more of a return of cash directly to shareholders in this way?
Well, I got pretty excited when I saw this new buyback authorization, an incremental $80 billion on top of another just about $40 billion that's already authorized. So by my math, that's over $100 billion that's now authorized. And then I realized that $100 billion on a $5 trillion market cap, unfortunately, doesn't really move the needle. But no, I do think that was one of the big announcements coming out of GTC in March. They're generating so much cash. They're gonna return half of free cash flow to shareholders, I believe, this year. If they continue that, there could be $1 trillion of free cash returned to shareholders over the next 4 to 5 years. So I do think that is part of the story. And for a stock that's trading at sub 20 PE, or basically a market multiple, I think that becomes important.
Last question, John, and that's really, what do you really want to hear from Jensen Huang tonight? I know he speaks quite frequently, and we just heard from him a couple of days ago, but is there something you really want to hear on this call in about 20 minutes, 25 minutes?
I want to hear about broadening out of the customer base and a broadening out of the product set. I think on the customer base part, hyperscalers at last disclosure, about 50% of the business, they're going to start breaking that out. That group is basically taking free cash flow to zero this year. So for Nvidia to continue to deliver really robust growth, you're going to need to see the customer base broaden out beyond that core. And then on the product side, I already talked a little bit about some of the Grok products and the standalone Vera racks that are coming later this year. You also have the Rubin transition coming. So I think there's going to be a lot to talk about on that front as well.
All right, John, we'll let you get back to it. John Belton, portfolio manager over at the Gabelli funds here as we continue to keep an eye on Nvidia. Those shares oscillating between gains and losses, and because it is the biggest weighting in the major indices, the world's most valuable company by market cap, it does have an outsized effect on everything else around it. Now, in the post-market, you are seeing a more significant reaction in a name like Applied Digital, which is up about 7.5% here in the after-hours trade. Meanwhile, AMD not getting much juice. Neither is Qualcomm or ARM. TSMC up about 0.2% here in the after-hours trade. We should point out that quite a few of the software names right now are in the red. That's probably more a function of the results that we got out of Intuit a little while ago rather than out of Nvidia itself here. But again, it's hard to understate the ecosystem that Nvidia and these high-end chips and the AI boom have built, and the idea that right now this is a company that in one way or another pretty much touches everything. Well, almost everything, and, well, that is China. One of the big headlines coming out was no surprise. No shipments of those Hopper products to China in the most recent quarter at all. And NVIDIA's business, is it dependent on that? Is there life potential for it to actually have a business selling to China? Does it even need it? Sara Hsu joins us right now. She's a clinical associate professor of supply chain management at the University of Tennessee at Knoxville. And Sara, I do kind of want to talk about this idea of what China is doing. And I know for some people it's a little bit of a black box right now. There's a lot of anecdotal evidence that they've made a lot of progress in trying to get up to speed on their own semiconductor technology, and they've managed to do it, at least publicly from what we know, without NVIDIA's chips. So I kind of put that in quotation marks there. What do we know about what they have, what they need, and whether NVIDIA even needs to be a part of that conversation?
Yeah, that's a really good question. So I think that, China definitely needs NVIDIA for training of its AI models, but it has been able to do a lot with very little with its Huawei Ascend chips, which have allowed it to really nail down the inference capabilities that it needs. And a lot of the AI companies coming out are using those Huawei Ascend chips and those ecosystems there, which have kind of gotten to a really high point of development by almost brute force, while China has lacked some of the tools that it's needed to use to reproduce NVIDIA's same sort of advanced chips.
Yeah, I was curious. I was looking at some of those names, Huawei, Cambricom, more Threads. I mean, there are a lot of names out there. No one's saying that they're anywhere near the level that NVIDIA is, but it gets to this idea here of just an acceleration that we're seeing over there when it comes to what China is able to get its hands on in terms of chip designs, chip equipment to make those chips, and everything ancillary to it. Do they have enough of a pipeline coming, obviously, from anywhere other than the U.S. right now?
Well, there are a lot of shortages in terms of equipment in particular, and that has become a major bottleneck for China's chip manufacturers. But, they have been able to get up and running in terms of making their smaller chips. SMIC has done better. And, Huawei, of course, has been able to design really high-level chips, even without some of those necessary tools. And so it's amazing how they've done some of it. They are lacking like the EUV machinery, a lot of the more contemporary, more recent models of the EUV lithography machines, but they've been able to sort of find workarounds repeatedly by using different types of processes to etch onto the chips. And they've also been able to put more of the sort of older generation chips together to create more compute power.
And we should point out for our viewers, we are getting additional headlines out of Nvidia, once again, talking about the situation with China, saying right now that they don't yet know if any imports will be allowed in China. And it gets to this idea, Sarah, and I don't want to get too deep into politics, but Jensen Huang, of course, was on that state visit by President Trump to meet Xi Jinping last week. From what we know, no deal was made. But do you see any possibility that there could be some sort of détente between the U.S. and China when it comes to some of the more advanced technology needed to build out the AI infrastructure?
Yeah, I don't really see that coming. Just because in the U.S. both sides of the aisle are pretty much against selling more advanced chips, and also not only that, but they're really in favor of blocking really the high-level machinery that China needs in order to produce those types of chips. I think that to some extent it was a fluke that Nvidia has been able to supposedly sell these chips into China, the H200 chips, but China has reacted in a way that has really sort of closed them off. Which it is, inclined to do, close them off from the U.S. and really try to develop its own ecosystem. It's put a lot of money, a lot of talent, and infrastructure into building up their semiconductor ecosystem. And so I would really be surprised if in the short run, Nvidia was able to sell into China. That doesn't mean that it wouldn't happen, because these days we're often surprised by the news. But I think that it's something that's more likely to happen in the medium run. And I would look for that in maybe 2-3 years down the line, but certainly I wouldn't expect it this year.
All right, Sarah, really appreciate you jumping on here in the moment. Sarah Xu, she's a clinical associate professor of supply chain management at the University of Tennessee down there in Knoxville. We are awaiting that conference call to start in just about 19 minutes here. Nvidia shares have been deep in the red. They have been higher in the green, now down about 0.6% here as we move closer to the start of that call. We're also keeping an eye on, well, the hyperscalers, one of its biggest customers, Microsoft, looking slightly lower here in the after hours trade, down about 0.2%. Amazon, Meta, and Alphabet all moving only slightly here. But of course, we know they are a big component here of the AI build-out. They have already spent billions, and they have committed to spend billions more on this build-out, a big chunk of that going, of course, directly to Nvidia. Joining us right now is Anurag Rana, a senior technology analyst over at Bloomberg Intelligence, to talk about the hyperscalers and what they plan to do. I mean, we got earnings out of them a couple of weeks ago or so, Anurag, and basically it was, we're raising our CapEx numbers. I think the official number in aggregate amongst the big four is $725 billion here. But I'm actually starting to hear from some analysts now, they expect that number could actually be revised higher before we get to the end of the year.
I mean, it is very much likely, frankly, when we see the backlog growing for all of these companies right now, it has been truly impressive to see how it has stacked up, despite a lot of this discussion around memory shortage and other things, because if the orders are there, these guys will spend. And that's really the reality right now. 26 numbers, we feel very confident about them, what they are in terms of consensus and our own estimates, as well as looking at next year's numbers being a little bit higher from where we are. So at least these 2 years, we feel relatively confident about CapEx coming from the hyperscalers.
Do you have any worries here just about the increasing costs to do what these hyperscalers are trying to do, whether it's the cost of power, the cost of land, the cost of labor, and not to mention, somebody gave me a whole list of chemicals and raw materials that have gone through the roof that I never heard of that are also raising costs as well. Will that derail this? Is that going to deter any of this spending?
Yeah, if you would have said we are in a very tight credit market and the lenders have some problems, I would have thought about it. But at the same time, when you look at the 4 or 5 companies that are spending this money, they actually have very strong balance sheets. So they can absorb some of these costs. Microsoft talked about, I think, what was it, $25 billion just on higher component costs. So all of them really want to be the big players when it comes to AI infrastructure. They really want to gain market share from each other and grab the bigger pie. So I don't think we're going to see them slow down spending just because the costs are going up.
In conversation with Anurag Rana over at Bloomberg Intelligence. Hold that thought. Two red headlines crossing the Bloomberg terminal right now when it comes to the AI revenue. Anthropic, privately held, closely held, according to the Wall Street Journal, says that it sees second quarter revenue of about $11 billion. And that is up sequentially from $4.8 billion in the previous quarter. Of course, Anthropic has the potential to be one of the biggest IPOs of the year, but it looks like someone might get out the gate before them, and that is SpaceX. We're now learning that Elon Musk's SpaceX has filed for a NASDAQ IPO. The ticker symbol will be SPCX, and it does look like we are also getting a little bit more of a peek at the company's numbers, with the company saying that first quarter revenue for SpaceX was about $4.7 billion, but the company is actually generating a loss, a net loss of about $4.28 billion. We should also point out Goldman and Morgan Stanley, as well as Bank of America, will be leading that SpaceX IPO, and there will be two classes of shares there, Class A and Class B. We're going to get you a little bit more details on that SpaceX filing in just a moment. I do want to go back to Anurag, particularly on the back of some of these headlines, and put it into the broader context, Anurag, of about this idea that, you know, what was sort of an AI race that to a certain extent was really just a small handful of companies is now that aperture is really starting to open up here. And again, I'm going to pose this question back to you about what sort of derails, at least what we know with these big hyperscalers, with some of these new, potentially new entrants coming into the market, as well as where some of money may sort of move around with regards to investors. Is that a risk in your view?
See, when you look at the hyperscalers, they have several things that are going for them. I think capital being the biggest one of them. The second piece is if you are trying to establish an AI application, you're most likely going to do it on the cloud, just because you as a simple company would not be able to come up with that infrastructure in-house. A lot of companies can, just big companies like JP Morgan will be able to, but most of the mid-sized companies will have to go to the hyperscale cloud providers. The second catalyst is it is actually leading to companies upgrading their internal IT infrastructure, which has, some people who have not moved to the cloud, they are accelerating that shift. So I think the leading indicators when we look at the hyperscale cloud providers is actually fairly strong at this point.
Anurag, we'll let you go. Anurag Rana, Senior Technology Analyst over at Bloomberg Intelligence. We are keeping an eye on shares of those hyperscalers, also keeping an eye on shares of Nvidia. And well, it's kind of curious here. Not much could overshadow earnings from the world's largest and most consequential company, but that's exactly what's happening. SpaceX has now filed for its IPO with the NASDAQ. The ticker symbol will be SPCX, and that filing is giving us a little bit more of a peek here into the health of this company. Bloomberg Tech co-host Ed Ludlow joins us right now. Ed, what do we know?
Yeah, first quarter revenues for SpaceX, almost $5 billion. What they're claiming is that this is a company where Musk being in total control, and as we've just headlined, which will need voter approval, is going to work because it's vertically integrated. The rocket platform is giving them the best opportunity to dominate satellite-based broadband connection. They basically are making the claim that even as of now, they are the leading satellite broadband provider. We're going through it, and what we're trying to work out is like the structure of what's going on. In the calendar year 25, company notched $11.4 billion of revenue. But clearly, if you look at like the jump from where they ended last year into the first quarter of this year, there's a really big acceleration here where in the interim, Starlink and space-based internet accounts for so much of it.
Yeah.
But they're clearly outlining the path forward here.
Yeah.
That is space-based data center.
All right, so just walking through a couple of the headlines, right now, Ed, on the Bloomberg terminal, Starlink has about 10.3 million subscribers, something that potential investors really did want to know here. The space segment revenue at about $619 million, total revenue for the last full year for SpaceX as a whole, $11.4 billion here. And I'm also curious about this, Ed, this idea that it's entered into a compute pact with AnySphere. And I want you to know if you could kind of, and you have to talk to me, like I'm a 5-year-old here, because this gets kind of complicated, about how Elon is sort of structuring this company and what he wants it to be, because clearly he's not envisioning this as just a rocket launch company.
No. Basically, why does SpaceX need to go public? For the function of raising lots of money. What they're outlining in the document, and it's dense, right? I've been through as much of it as I can in 6 minutes, is a world where if they get their rocket launch system fully reusable and the cadence right, they build out a massive network of satellites that operate as data centers. But the point of the data centers is inference, running AI workloads on a dollar per token basis that would make them, if they can get the economics of it right, better and more competitive than a data center here on Earth, terra firma, that's a big tin can with lots of servers on it. And the money raised from this IPO, which we can get into in a sec, is used to buy GPUs. It's kind of simple equation from that standpoint.
Well, it might also be used to buy Cursor. We actually had the report from Rachel Metzner and her colleagues a few days ago here that SpaceX had planned to buy a Cursor 30 days after the IPO. Now that headline, Ed, crossing the wire right now, saying that they have entered into an option pact to buy Cursor. Explain that.
Yeah, so basically, SpaceX had the right to acquire Cursor for $60 billion, or a $10 billion agreement to license its technology, which prior to the disclosure of this S1 was seen as a breakup fee. The reason that they had the right to acquire is rather than getting the transaction done prior to the S1 flipping and them going public, is it probably would have extended the comment period with the SEC and required them to redo the documents, basically, a material financial change or disclosure. So what we'd reported, and I think is now basically confirmed, is that once they do go public, they will move very quickly to bring Cursor within the SpaceX AI broader company.
One last question, and this, of course, was something that a lot of people were curious about, and that was what the relationship could potentially be with Tesla. Now, the main headline we have right now is that according to SpaceX, the transactions with Tesla in the first quarter of 2026 and all of 2025 were, in their words, immaterial. They did say that SpaceX did purchase $131 million of Cybertrucks, which I believe was already reported here. But is that immaterial nature of that Tesla relationship with SpaceX? Do you think that will remain immaterial?
The number one question that I got in advance of the S1 flipping public is what would we learn about Tesla? And as you know, we reported prior to SpaceX filing confidentially for an IPO, even prior to it merging with xAI, the boards of SpaceX had talked with the board of Tesla about that being an alternative pathway. There are many in the markets who believe that there is still a future where SpaceX and Tesla merge. We don't have any updated reporting on mechanics on that. But prior to SpaceX xAI and much prior to this S1 flipping into the public domain, it is something that people have been asking about constantly. And they work with each other, right? They all have the similar goal now, which is AI in different physical parts of the world.
All right, Ed Ludlow, co-host there of Bloomberg Tech here. A lot going on here in the after hours trade. Of course, SpaceX now making that S1 filing. And this basically sets the stage for them to actually start the roadshow as soon as the first week of June, which means this could actually be a public company potentially by maybe the second week of June. We also had some red headlines on a story from the Wall Street Journal with regards to Anthropic, the other big AI company out there, providing some of its revenue numbers as we are all awaiting potentially an IPO for that company. And then, of course, earlier in the day, there were reports from the FT and other sources that OpenAI was getting ready to make a formal confidential filing for its IPO as well. All of that, to a certain extent, overshadowing the results that we just got out of Nvidia and a conference call that's set to start in just about 9 minutes time, 8-9 minutes time here with Jensen Huang and company. And a lot of questions out there aren't going to be just about their numbers, but more importantly, about the numbers of all the companies that have helped to fuel this AI boom, the hyperscalers and this big CapEx spend, and whether it can actually continue. John Medina, Senior Vice President and Global Project and of Infrastructure Finance over at Moody's, joins us right now. And John, I think this is what everybody wants to know right now. We're talking, at least on the big four hyperscalers, $725 billion is what they've sort of articulated already. I believe I saw a note from you just maybe last week or the week before. You're actually starting to guide that a little higher, saying that they're going to spend more than that. Why?
A lot of it has to do with where we are in the build cycle. So it's a good question, Romain. We are increasing our numbers. We have $785 billion for the 6 largest hyperscalers this year, increasing to $1 trillion next year. So where is that money going? It is going to the computing equipment, right? So we talk about the AI financings, right, to build these data centers. Once the facility is built, you then can put the computing equipment inside. So with all of these data centers opening this year, next year, and the year thereafter, the largest cost ultimately is that computing equipment at the end. And that's why you're seeing this increase. I think our forecast increased 17% from just 2 months prior in the CapEx that we were forecasting for these 6 hyperscalers.
There's a lot of people concerned about the cost of money and what it takes to actually fund this. The narrative a few months ago, a year ago, was, okay, these were companies with deep pockets. They had cash on hand to do that. But of course, even though they had the cash, a lot of them went to the debt markets at relatively favorable conditions, we should point out. But of course, that's not going to last. And there are going to be a lot of other companies coming to the debt market that don't have the pristine balance sheets that a Microsoft or Alphabet have. What does that mean in terms of what they're going to pay to actually borrow?
What we're actually seeing is in the data center space and now in the GPU financing space is that these same hyperscalers are the ones ultimately backing these long-term leases, directly or indirectly. And so the financings that we're seeing in the high yield market, for example, in the 144A market's been pretty active in the last 6 months. They're ultimately still coming back to these high-rated hyperscalers, right? The operators, the developers may be new, may be less experienced, but the payer of those bills, the one that's benefiting from that compute, still comes back to these high-rated hyperscalers. So the narrative is still there. The question is on term, right? We're seeing longer leases. We're seeing de-risking of these new projects. So from a credit perspective, while the projects are getting larger, they're actually having lower risk profiles, given some changes that we're seeing in these leases with these high-rated tenants.
All right, hold that thought, John. We do need to take a commercial break in a second, but we've got a lot more to talk about. We are extending our special coverage of the results that we just got out at Nvidia, and we should point out 2 other major breaking news stories happening amidst all this, and that, of course, a peek at some of the revenue numbers with regards to Anthropic, which could go public sometime later this year. That report coming out of the Wall Street Journal, and Bloomberg getting its hands on the S1 filing from SpaceX of the mega IPOs set to come down the pike this year. It looks like SpaceX will be the first one out of the gate, filing an S1 earlier today, which sets the stage for a roadshow to start in short order and a potential listing on the NASDAQ and trading to start as soon as the middle of next month. We are keeping an eye on Nvidia as well. Those shares continue to oscillate between gains and losses. We'll continue our conversation with John Medina, as well as some of the other key players in this space as we start to parse what is a rapidly changing world of financial markets and our economy. We'll be back in a moment. This is Bloomberg. Welcome to our Bloomberg audiences worldwide on TV and radio. If you're expecting Joe, Matthew, and Kaylee Lines, we are extending our coverage here of the results that we got out of Nvidia just a little while ago. I am Romaine Bostick, the host of The Close, and we do just want to reset here because we have 3 big stories happening here in the after hours trade here in the late afternoon in New York. That includes some disclosures of Anthropic's financial situation. Of course, this is the behemoth AI company that most people expect to go public at some point later this year. The Wall Street Journal reporting some of the figures out of that name, saying that revenue for the current quarter for that company is going to be roughly about $10.9 billion. That's up from about $4.8 billion in just the 3 months prior. So a more than doubling. It gives you sort of a sense here of the pace of growth that we continue to see in the AI space. Of course, also adding to this, not necessarily an AI company, but certainly one that is adjacent to that, that is Elon Musk's SpaceX. He has now formally filed the S1 with the Securities and Exchange Commission here in the United States to list SpaceX as a public company on the NASDAQ exchange. The ticker will be SPCX. We did get a peek at some of those numbers there. The revenue, okay. The company's still making losses, but of course, there's a lot of questions here about what he bolts on to what is effectively now a rocket launch company, but one, of course, that Elon Musk has made clear he has much bigger ambitions for. Now, all of that coming against the backdrop of earnings that we just got out of the world's largest company, the dominant maker of chips for the AI revolution, and that is Nvidia. They reported $80 billion in revenue in the most recent quarter. They reported 80% growth in their bottom line. And they gave guidance for the current quarter slightly above analyst estimates. And Jensen Huang, the co-founder and CEO of that company, now on a conference call with analysts taking questions about what comes next for Nvidia in the broader AI space. Ed Ludlow has been covering the broader AI space ever since ChatGPT came into the public consciousness just about 3.5 years ago. He joins us right now to kind of walk us through what we learned today with Nvidia, Ed, and more importantly, as to whether the AI boom, and that's really what everybody wants to know, what kind of legs are left in this run based on what we can glean from Nvidia's earnings report tonight.
Yeah, $91 billion plus or minus 2%. The revenue outlook for that current period, fiscal second quarter, it's bang on the whisper number, right? The most bullish elements of the street saw revenues being that. And we've seen the stock bounce around in after hours because it doesn't tell the broader story. Yes, there are some facts we know. It does not assume any revenues from China. It does not assume any sort of kind of newer business, although in the CFO commentary, Colette Kress says it's not just GPUs we're selling now, it's the networking, the Ethernet, everything that goes into the data center that's kind of accounting for the outperformance in the near term. Probably remain the big question going into this call is, have you moved beyond the hyperscalers? Because if you look at the breakdowns of revenues, now fleshed out better under data center going forward, hyperscale is still the mainstay of it. And going into it in aggregate, if I was to say, what are the sell side and the buy side calling for? It's a new story.
Yeah.
You know, in a beat and raise expectation market, the numbers don't even matter.
Yeah, I mean, if you run the SPLC function on your Bloomberg terminal, 22%. Of this money coming from Microsoft, 14% roughly coming from Amazon. You throw in Supermicro, Alphabet, Meta, and a few others here, and you see the concentration. You had a chance to talk to Jensen a couple of days ago, and I am curious about what he sees as the potential to broaden out this company's customer base. And I want to zero in something that jumped out at me, and it jumped out to a couple of investors we spoke to on the close earlier. This idea that it's going to not only report as a separate line item is data center revenue, but something called edge computing, which is kind of a fancy way of saying, you know, all the little devices and other things that we'll be using to facilitate whatever sort of AI tools and software we have. That's a small part of their business, $6 billion or so revenue in the most recent quarter compared to the $80 billion of revenue that it made. Why break that out? Is this the future for this company?
Well, the edge computing category is only growing at sub 30%, and the data center business growing, I think you nailed it right, it's around 80%. And what was interesting about being there in Las Vegas on Monday is the relationship with Dell. When you say at the edge, you basically say you are running AI inference on a device or a computing platform that's local to you. What's old is new. Right? So we've been so focused on the hyperscalers. But another way that NVIDIA is looking beyond the hyperscalers is there is a market now for companies of all sizes that are going back to wanting to build and operate their own data centers for lots of reasons. Security of data, more direct control, what the industry calls on-prem. Now, what's murky about that is, would an on-prem new line of business be reflected in this new data center category, or would it be reflected in edge computing? Technically, both things are true, but probably it would still go into the data center thing because that's where the value is. It's the GPU that goes into the server tray, not the GPU that goes into a PC, laptop, or a video games console for sure.
Ed, thanks for joining us here. I have the feeling we'll talk again soon.
Sure.
I'm sure. Ed Ludlow, he hosts Bloomberg Tech, of course, which airs every day at 11 a.m. New York time here, and he'll have a much deeper dive of that tomorrow with Caroline Hyde. We do want to go to John Medina. He is the Senior Vice President of Global Project and Infrastructure Finance over at Moody's, as we extend our special coverage here of NVIDIA's earnings into this second hour this afternoon. And John, I do want to pick up on where Ed left off. This idea of this sort of next phase of the AI revolution, the edge computing, and more importantly, are we going to start to see the same CapEx needs and financing needs for that we're seeing with sort of the traditional data centers?
I think we're going to see an evolution from what we've already talked about, right? The training of the models to the inferencing, right? Sort of deploying those AI tools that we're using on a daily basis, which often happens in those data centers located on the edge, right, of the market. I think new technologies, new products that were being discussed by Ed just a moment ago are possible. The question is scale. I don't necessarily think we're going to see this huge amount of a wave of investment that we're seeing right now for the data centers because they're so much larger. And it's not likely to see that outside of that going around the world. So the US is where you're seeing all of this investment right now. Most of it is concentrated here. Europe is starting to take off a little bit. South America is picking up, Asia Pac, Australia. So as the markets grow more globally, I think you're going to see growth probably there faster than you'll see on the edge computing.
I am curious when we talk about this build out, and I'd be remiss in not bringing up some of the criticism. A lot of people trying to make parallels with the 1990s dot-com boom and bust. And look, with a big asterisk, we know that the companies involved today are much different complexion than the companies that everybody was piling into back in the mid to late 1990s. But I am curious if, particularly from a credit perspective, credit worthiness perspective, are there any lessons that you look to from that era that we can apply to today?
Very much so. The first lesson being pre-lease all of the capacity to a high-rated investment-grade tenant. Nothing is really being built on speculation. I think that's one of the bigger differences. The other difference right now is we may be seeing a construction bubble, but we're still underserved on the compute side. There is not enough compute to meet the outstanding demand. I think the three largest cloud providers have $700 billion of contracts unfulfilled. That wasn't the case in the 90s. You were building towards what could come. Here, you're building for what is already needed. So we're catching up on that supply-demand imbalance. So we have a few more years to go until we may even see some balance there. That's a huge difference, I think, from the late 90s when you were seeing a lot of fiber build, a lot of smaller data centers. And I also think now that the use case, the exponential use of compute is very different, given we all have smartphones and we all use them on a daily basis in our workflows, whereas that was very different, 20, 30 years ago when we were seeing that big fiber build out that ultimately did get used. So if there is maybe excess capacity built during this construction wave, it will get used over time as the demand for compute continues to rise.
I am curious, though. I mean, does it matter where the money comes from? I mean, I'm looking at, the projections that Moody's has put out, $3 trillion in spending, I think through 2030, if I remember that correctly. I mean, does it matter the complexion of that, whether that comes from the corporate bonds themselves or from private capital or, maybe some other source that we don't know about?
The sources of capital are any source of capital that's available because the numbers we are talking about are in the trillions. So right now we're in a development space, right? So that's a lot of equity. That's a lot of construction loans. That's a lot of 144A capital markets, right? So what we're seeing now is how do I get a fully amortizing project day one in construction so that I can access more institutional investors, right? I have no more lease renewal risk. I can pay off my debt in that first lease term. That opens up a new market. So I think that new investment grade 144A private placement market is becoming a bit more active as they're becoming more comfortable with the asset class and learning about the risks.
But when it comes to those risks, though, I mean, we were speaking with Ankur Crawford over at Alger yesterday on The Close, and she made a good point. At least with some of the more pristine companies, the Microsofts, Alphabets, et cetera, they're borrowing at relatively low rates. They're also employing convertibles, which effectively takes their interest rate into some cases into the 1% to 2% range, well below what we're seeing with benchmark interest rates. But then I look at XAI, which recently borrowed at 12.5%, CoreWeave, which borrowed at 9%, and a few other companies that basically are borrowing at high yields. And I'm wondering if that becomes a risk in and of itself. I know we're seeing a ton of growth in terms of the market, but when you start to see that type of interest rates attached to something like this, I mean, does that not give you pause?
I think it's a reflection of where those companies are in their own life cycle, right? The high yield companies tend to be newer, younger, but they're also becoming more innovative in the sense that they are structuring around these contracts that they have with high-rated hyperscalers such that they can remove their own credit risk from the structure and tie that credit of that particular financing closer to the tenant, which is that high-rated investment grade tenant. So even CoreWeave has had multiple projects where they were the tenant and they were actually pricing it better than what you were speaking to. Same thing in their GPU financings. We rated $8.5 billion financing recently that actually priced much better than you're saying. And that was just in March. And I think the spread there was 225, on that for an investment grade rating. We had an A3 rating on that. So I think you're seeing innovation for these neo clouds that sort of want to access capital markets. They can de-risk by removing their credit from the process. But if it's directly on their credit, it is going to be a newer company that's still in its growth mode. So definitely more high yield.
Yeah, and speaking of growth, we should just point out we're getting some headlines out of that Nvidia conference call. The CFO, Colette Cresta, speaking right now, talking about the breakdown of their data center business. They're also saying that they see AI spending reaching $3 to $4 trillion annually by the end of this decade. want to ask you, John, about this idea, not so much of the quality of the potential borrowing, but also about the duration. And there's been a lot of talk about this idea that, you're dealing with a technology that's moving so fast. If you're selling bonds for 10 or 20 years or longer, are you sort of taking on debt duration that is completely out of sync with, I guess, the underlying asset, more or less, that's supposed to be sort of supporting, the payback?
It really depends, I think, there on the asset, right? What we're seeing for the AI data centers, for the newer ones that are coming to market, are longer leases so that you can repay that debt in that 15, 20-year period where you're not taking ultimately technology risk because you have direct risk with that hyperscaler. So while the internal compute may change, the facility itself is the same. On some of the new GPU financings that we're seeing, which have shorter terms, maybe 5 years, 6 years, to match, again, fully paying off that debt within that contract term. So you are getting longer duration to some of these companies, but it's ultimately in an indirect space through these leases that they're signing. And I think they're doing a decent job of matching sort of the useful life of the long asset itself with the financing that they're matching it with. So there's multiple levels of financing that you often see with these AI data centers because there's different components that need to be financed and can be financed in different markets that try to match the risk profile with the duration of the debt as well.
Do you feel comfortable or confident enough that you're getting an accurate read on the health of these projects, given that some of these deals, of course, are off balance sheet, and I know that there's still disclosures they have to make, but is it giving you a complete picture of the health of what's out there and the creditworthiness of what's out there?
I believe our analysts are doing a good job of incorporating this forward look. So when we look at these big companies, we also look at what's coming, right, in terms of CapEx, in terms of leases, in terms of quote unquote contingent liabilities or residual value guarantees or other off balance sheet liabilities are very much incorporated into our analysis moving forward. Because as you know, these companies weren't going through these cycles before. So we have to kind of incorporate that up front as best as we can. We do also work cross team so that all of our analysts are aware who's signing the power contracts, who's signing the real estate contract, who's signing the GPU contract, so that we can tie that back ultimately to the companies to try to incorporate the most holistic view as possible for these on balance sheet and off balance sheet liabilities. So we incorporate that into the ratings today.
John, really smart and really appreciate you giving us so much of your time today. John Medina is Senior Vice President of Global Project and Infrastructure Finance over at Moody's. As we continue our coverage of Nvidia and quite frankly of the broader AI space here, that conference call now going on with Jensen Huang. The share is under pressure right now, down about 1% here in the after hours trade. We're going to get some insights out of what the investors think. We're going to talk to the CIO and Chief Market Strategist over at Truist when we come back after the break, right here on Bloomberg Television and Radio. Welcome to our Bloomberg audiences across television and radio. Our extended coverage of earnings out of Nvidia, the world's most valuable company, reporting results for the 3 months ended in the end of April here. Nvidia's sales gaining 85% to $82 billion. That's above analyst estimates. Profit, when you subtract some items, also jumped about 80% to about $1.87 per share. Adjusted gross margin, that's a percentage of revenue remaining after you deduct all those costs. That was 75%. The share is, though, under pressure here right now as that conference call is underway with the CEO and CFO of Nvidia. Joining us right now here on Bloomberg is the CIO and Chief Market Strategist at Truist Advisory Services, Keith Lerner. And Keith, I want to get your reaction not only to the growth rates that we continue to see, but also the idea here of sort of what those growth rates could potentially be a longer term. We know there's increased competition coming up on the chip side, and we know that the broader ecosystem when it comes to AI is going to be, well, let's just say a lot more crowded than just Nvidia. Are you happy with what you're hearing tonight?
Yeah, well, great to be with you. And I would say, I mean, overall, it's a blowout number. The stock has moved up 30% ahead of this number, so the reaction is somewhat mixed. But we're talking about a company, the biggest company in the world, growing their revenue, as you just said, 85%. So that's pretty outstanding. Again, I guess the question is, at this point for investors is, people know the story, they're comfortable with the story, so it's not a big surprise. People expect them already to have really big numbers, and that's why I think in the after hours you're seeing more of a mixed reaction so far.
I mean, there is some concern about just how much this phenomenal growth rate can be. I've talked about this a lot on The Close, the show that I host every day. And this idea that a few years ago, this was a company in decline. You know, the graphics chips that they were popular with gamers and crypto miners, that was starting to wane. And it sort of found this new life in AI and has just become a behemoth, 22 times what it was just, 5 or 6 years ago in terms of revenue. Obviously now the world's largest company. And look, let's face it, you can't keep growing at 80+% when you're a $5 trillion company, or can you?
Well, I mean, I think that's why the stock is trading at a multiple in the low 20s. If you looked at a revenue growth of 85%, if it was a smaller company, it would probably be trading at a much higher multiple. So what is the market telling you? The market is telling you that over time, that growth rate is going to come down as other players, whether it's Google, whether it's Amazon, come in and try to chip away at their gross margins. I mean, in today's report, the gross margins stayed pretty steady. But again, all in all, the market is reflecting that it expects a slowdown in that growth, but again, still pretty healthy. And overall, for the semiconductor industry, I think this just tells you there's still huge demand for compute. And even though these semiconductor stocks have had a big run and are due for a pause, they're extended, I think this will just validate that the dominant theme of this bull market that is still very much intact is AI and tech. Again, after a breather, I think the overall space, the technology space, is still leadership in this market.
I am curious, too. They are also talking about now, an $80 billion buyback program. You add that to the $20-something billion that they had before. That's $100 billion that maybe could provide a boost for the stock, though kind of hard to do when you're already at $5 trillion. But also a dividend, 25 cents, up from a penny. So basically from nothing to something substantial here. Does that become more of a story, at least from the stock perspective, that Nvidia and Jensen Huang are going to have to find a way to return more cash to shareholders?
I mean, that's probably part of it. It also brings on a different investor base. Some investors really focus more on dividend and dividend growth. So I think that's a positive. Again, my focus is more at the macro level. But all in all, it just tells you there's a lot of cash flow for them to increase their dividend. They have to have confidence that they can pay that dividend and grow that over time. And that's what they're doing today.
Keith, really appreciate it. Keith Lerner there, CIO, Chief Market Strategist over at Truist Advisory Services, as we continue our coverage, our extended coverage of NVIDIA's earnings report and conference call. That conference call now underway, and it's partly being overshadowed by another big story, SpaceX. With a long-awaited IPO is now potentially here. That company filing its S1 today, and we're getting a much more detailed peek into the health of this business as it prepares to list and begin trading at some point, potentially next month. Anthony Hughes joins us from Bloomberg News to talk a little bit more about it. All right, Anthony, let's go through some of the numbers and kind of what we know about the state of this business, and more importantly, about what the state of the business could be based on Elon Musk's vision. What did we learn out of this filing?
We're still going through all the financials, the business is obviously changed a lot in terms of its complexity in recent times because of the acquisition of XAI. I think one of the interesting things that people are going to look at is the losses in the XAI part of the business, and they're pretty substantial. Overall, people will be looking for the growth, the optionality and the growth that's that's in the future. And I think the thing with these filings is they don't really offer any forecast for the future. So at the end of the day, you're looking at really a historical view of their profitability, and I think people can see the numbers there. But
we can see the numbers there. I mean, let's face it. I mean, we're talking about Elon Musk here. A lot of people who are on the Elon Musk train, they don't necessarily invest in his companies based on the quarter-to-quarter earnings picture, but on his moonshots, if you will. Coming out of this filing, he's talking about how some of the compensation structure is tied to actually having a colony on Mars, actual people on Mars. These are pretty lofty goals, and who knows if he will ever meet them. He's bolting on, as you said, XAI, potentially buying Cursor. Who knows what the relationship is going to be with Tesla here. As this comes to market, there's going to be a lot of questions about how the market absorbs it. This is going to have a valuation north of $1 trillion, pretty much right out of the gate, and potentially a lot more than that here. Is there enough appetite for that?
Well, I think the indications are that there is a lot of appetite for a deal like this, and the offering will be structured in a way that will should ensure some success early on, because at the end of the day, the numbers, even though the numbers aren't in the prospectus here, the IPO is really going to be of about 4% of the company. That's what our current prediction is. Yeah. And on that basis, you're creating a supply and demand dynamic, which should still be, it should be still a sense that the stocks are scarce, and and as you just pointed out, I mean, this business is, something that we really haven't got our heads around compared to, all the different other companies in the market. Massive space company, but also a company that has AI and a connectivity business, a telecommunications business there too. So, I mean, this is really something different from anything we've seen before, and I think, that scarcity value is something that's going to drive a lot of demand. And we just saw an IPO last week, which, was 25 times oversubscribed and raising $5 billion. So we know there's a lot of money out there, and we know that this deal has a number of quite a lot of institutional investors who have already put their hands up to take a lot of the stock. So, it is a very large offering, and it will probably have some negative impacts on other parts of the market. Yeah. And people clearing up some, there's some signs that people are, making room for this.
All right, Anthony Hughes there from Bloomberg News here. The key takeaways there in the most recent period, revenue up 80% last year from 2023. Its cost did increase. It does have a debt load in the roughly about $29 billion. There will also be a dual class share structure that will effectively give Elon Musk more or less total control over this company. We're going to continue to follow that with our extended coverage here of what's been going on in the broader tech and IPO space. Animesh Garg, professor in the School of Interactive Computing over at Georgia Tech. He'll be joining us in just a second, right here on Bloomberg. Welcome to our Bloomberg audiences worldwide on television and radio. Extended special coverage of those earnings that we just got out of Nvidia. The broader AI space, the broader tech space has been in focus all afternoon long, and it's not just because of Nvidia. Just a few moments ago, we learned that Elon Musk has filed to take his SpaceX company public. Ostensibly, it's a rocket launch company, but clearly his ambitions are for something so much more. Joining us once again is Ed Ludlow, the co-host of Bloomberg Tech. And Ed, I do want to start there and the broader ambitions. XAI, Cursor, maybe Tesla, who knows? But obviously, he's trying to build something that is much bigger than just launching rockets. He's even put, I'm looking at this filing, Ed, some of the targets that they have for compensation and shares based on having a colony on Mars. Now, we know Elon Musk is no stranger to lofty projections. Some of them he meets, some of them he doesn't. This is going to be a behemoth of an IPO, the world's largest, no matter what. And I am curious as to your take as to what he's offering investors and whether you think investors will take it.
An AI future. SpaceX's founding and still kind of core principled mission is to make humankind as a species multi-planetary. It's in the document. But actually, if you want to go by the numbers and what they're trying to convince investors of to justify the IPO, either by valuation or the dollar raised, it's the total addressable market they're going after. So what they're saying is they see a TAM of 28.5 trillion. Only 2.5 trillion of that is infrastructure, but 26.5 trillion is them going after basically AI inference in space. And they're very clear that what you're showing on your screen right now, Starship, is the biggest risk factor in unlocking that, because basically they need that very large rocket that's on your television screens right now, if you're with us on Bloomberg TV, to put these things into space. The numbers are just wild, but the story they're telling is clear.
Yeah, I never thought I would actually ask this of anybody, but when is that next rocket launch, Ed Ludlow?
Well, it is scheduled. The 12th test of Starship, the V3, a re-architecture of it for Thursday night, 6:30 p.m. Eastern, but the weather's not looking good. And so, without exaggeration, I really mean this, the timing of this S1 is also wild, because they're spelling out in no uncertain terms, all of this is predicated on us nailing this rocket. They're going to test it tomorrow, maybe, if the weather's good. It's astonishing.
Well, that's what I'm curious about, and we kind of knew that based on some reporting by our Bloomberg reporters, that obviously this is going to be kind of a show and prove moment for them. Whether that actually dents the IPO or not, who knows? But it gets to this idea that, am I supposed to look at this company as space data centers? or as a rocket launch company, or maybe something a little bit more terrestrial. And I am wondering how he pitches this. And I understand there are people who are going to buy this just because he's Elon Musk and they look at his track record and what he did. But he's also, and we have to just be very upfront about this, he is a man who has shown some flaws in recent years, both in terms of his management as well as his personal style. And I am curious as to whether that has any potential impact, if at all, on this endeavor.
Prior to this offering, based on the filing, Elon Musk has 85.1% voting control of this company. Right, and I think what you're getting at is what we often say is one of his greatest skills is to keep investors looking to the horizon. You know, often he'll make a prediction on a timeline, he'll miss that timeline, his own, but get there in the end. And, you know, there's a whole page in here dedicated to the idea that if Elon Musk were to go away tomorrow, SpaceX would be in serious trouble. You know, it's in the boilerplate, sure, but it's the risk language could not be more clear that, you know, the pitch in this IPO is that this IPO is also Elon Musk. And he's critical to the future they're outlining. Yeah, I mean, normal sort of fundamentals, normal corporate governance would say this is a risk, and he is 54 years old, which is still young, but something that, but I am curious too, just before we let you go, Ed, I mean, you've interviewed what I would say, forgive me if I mischaracterize it, the person who's really running SpaceX. And I am curious as to whether there should be more emphasis on her and those other people there rather than on Elon Musk, who I know one way or another will be the face of this company. Yeah, there's a very deep bench of talent at SpaceX. Gwynne Shotwell's the president and operates basically as COO. Bret Johnson is the CFO. But, you know, again, it's codified on whether it's voting control or this sort of, as is spelled out, the genius of Musk that carries them forward. He's still central to it. I don't know that that answers your question, but, you know, SpaceX has been able to retain top talent through the secondaries market and the private markets. They've done tenders often to keep those people and give them liquidity through their stock comp. So there's an army of people there that are behind the company and behind Musk. And that's what I'd answer your question, beyond the idea that, you know, even if Musk's main skill is keeping everyone looking into the future, on balance, you know, he kind of delivers in the end often. All right, Ed Ludlow, the co-host of Bloomberg Tech. A closer look here at that filing by SpaceX for its IPO, an IPO that could actually make it to market within the next 2 to 4 weeks. Meanwhile, we do want to go back to Nvidia, that conference call going on with Jensen Huang speaking on the conference call, saying that the company expects to grow faster than hyperscaler CapEx. Remember, the 4 largest hyperscalers here in the U.S. have already committed to spend about $725 billion this year alone. Some of the broader projections looking at about $3 trillion overall by the time we get to 2030. Now, our next guest really sits at the intersection of what's going on in AI and in robotics. His name is Animesh Garg. He's a professor in the School of Interactive Computing and a former senior researcher at the Nvidia Research Lab over at Georgia Tech. Animesh, great to have you here. I am curious about not so much the spend, but more importantly, when you look at the amount of money that's being invested into the AI space, is it being spent appropriately in your view as a scientist?
I believe this technology has taken everyone, frankly, by surprise with the space or with the speed with which it has made progress. And as a result, the spends have grown remarkably. I do believe that the productivity gains that we have seen or we hope to see will justify this investment fairly soon. As an AI researcher, I believe this is a technology that is fundamentally reinventing computing and at the scale that we have never seen before, at least not in the last 50 years. So this investment does indeed sort of justify itself.
There's been a lot of talk, obviously, about the data center build-out. That has been the dominant story. We're now starting to talk about edge computing. NVIDIA itself today said it will start reporting out its edge computing revenue as a line item. On top of that, there's been a lot of talk about physical AI. That's your expertise. And I am curious if you can expand a little bit, and for the layman out there, what exactly that means. And are we there yet, or do we still have a ways to go to get there?
The edge computing market, the physical AI market are very deeply entwined. Fundamentally, all robots or all machines that will move will require some amount of intelligence directly on board or through some data center. Now, this is something that is up and coming. Robotics, particularly general purpose robotics, is at a point where we expect an inflection in the next 2 years, which would mean that we might see a boom in not only knowledge work that we have seen in AI, but also in physical work. And it may be actually bigger than what we see today. We might still be a little bit out, and the projections are somewhere between 18 months to, 4 years, where we might see the GPT 3.5 moment that we saw 3.5 years ago in the knowledge workspace.
So, I mean, what exactly, though, does that look like? And in practical terms, are we just talking about, robots, in warehouses and factories, or is it something maybe a little bit more, intelligent than that, for lack of a better phrase?
I think if we do end up seeing something like a GPT moment, fundamentally our perception of what robots are will change. Robots will be the new computer, right? In the same way we had the PC, this would be the physical computer. And once you have that, then all types of physical work, whether it's the usual enterprise grade work, whether it's warehouse, retail, a hospital, or other work, but also new types of work, whether it's in entertainment or education, or even some sort of new categories, whether they are handicraft or specialized work, they will all open up. I think the bigger picture that we should really be looking at is if we are able to solve general purpose work or labor, what opens up. I think it's very limiting to see only what work is being done today, but I think it should be more interesting to see what is not being done because we are constrained on labor.
I am curious, too. I don't want to get too into public sentiment, but I mean, obviously, what you're talking about from a scientific perspective, I can see how that will excite people. From a practical perspective, it's going to scare a lot of people because most of our association with robots, at least in the way that you're talking, are from sci-fi movies where usually they don't end very well for the humans. You are at a major university. I was just down there, actually, believe it or not, just a week or so ago. I am curious about the interplay with what your students are learning, particularly those in the robotics program, but also some of the sentiment we've seen at universities, particularly during the commencement season, where we've seen commencement speakers talking about the future of AI, the need to embrace it, and, well, let's just say a very visceral and negative public reaction by some of those folks in the audience. Have we moved too fast? Are we actually ready for this as a public?
I think the advent of AI has definitely upstaged a lot of the processes we had, both in education and in early career, let's say, employment. However, we do believe that AI is now becoming very quickly what computer use used to be in the 1990s. Everyone is going to use it, be fluent with it, to improve their own productivity. Now, of course, beyond that, we will also need people who understand the internals of it so they can understand, gauge, improve, and accurately build guardrails so that we can inform not the public, but also the policy around it. I think there is a transition phase. You are absolutely right. But I do believe that this is for the positive of the community rather than something that we need to frown upon.
Animesh, really appreciate you taking time for us. Animesh Garg, he's a professor in the School of Interactive Computing down there in Atlanta at Georgia Tech University. As our coverage here of NVIDIA and the broader space, AI space, tech space, and everything else. We're covering a lot this afternoon, and a lot of it is getting mixed up here, but ultimately, it's all pointing in the same direction, and that's our future. We're going to talk a little bit more about that future when we come back, particularly through the lens of that SpaceX IPO filing, with Eva Ados when we come back after the break on Bloomberg Television and Radio. Welcome back to our Bloomberg audiences across television and radio. Special extended coverage of what ostensibly was a show about those earnings out of Nvidia, the world's largest company and to a certain extent the most consequential. But it's also a day and really, quite frankly, a narrative out there about just how much the aperture is broadening. There are quite a few privately held companies, incredibly large ones, that are set to come to market. Canva, Stripe, Databricks, Anthropic, OpenAI, and just about an hour ago, we learned that SpaceX, the company controlled by Elon Musk, is set to go public as soon as next month. Greg Martin joins us right now He's managing director of private markets at Rainmaker Securities. And Greg, at least two of those names are going to come to market with trillion-dollar valuations, maybe a third as well. And even when you throw in the other names in there that aren't at $1 trillion, this is a lot of market value coming into the public space. Do you think the public markets can handle it?
That is a great question. We've never seen anything like this. It's historically significant. You know, we could, if you think about the entire IPO market last year, SpaceX basically doubles the market from last year, and then you layer in OpenAI and you layer in Anthropic, and you could, 4x in 3 companies the entire market from last year. And then you layer in the fact that the S&P 500 may be forced, and the indexes may be sort of forced to purchase these companies, right up front, and they could truly suck the oxygen out of the room for other companies. So there could be a major disruption to the overall public markets when these companies come to market. But what we do know, we're really going to test how much capital there is out there for these hot new private companies. So it's going to be a very exciting next couple of quarters.
Yeah, that's what I'm curious about, too, because I was trying to go back in history the few times we've had these big IPO booms. I mean, there really is no parallel. I don't mean just in terms of the aggregate amount of value, but just as a percentage of what the public market is. So this is going to be a real test of that. But I also kind of want to get to the idea, too, that these are companies that, let's face it, to a certain extent, are part of what I think most of us assume is probably one of the most transformational moments in society. Full stop. Certainly in our lifetime, and I have a feeling we'll look back on this and probably say this potentially is probably one of the more transformational aspects we've seen of our society, and probably since the Industrial Revolution. With that in mind, Greg, I am curious as to whether we even need all of these companies in the public market. Some of them have done just quite well in the private space.
Yeah, that's a good question. I think that the amount of capital, and of course SpaceX's S1 was very revealing today, because SpaceX, which was for many years a very profitable company, is now talking about major CapEx investments. And Anthropic and OpenAI are no stranger to significant capital investment requirements. And the reality is, as good as the private markets have been for all 3 of these companies, and we've seen their valuations grow meteorically, they're still not tapping into the much larger open public market world. And so all 3 of these companies do have an insatiable need for capital, especially with their, transitional, disruptive growth opportunity to grow AI and the investment that's required for that. And so I do think that they need to be public. There's no reason for them to be choked off in the private markets, as good as those have been. So I think their time is now. And I think the public markets, and based on what we see at Rainmaker, there are lots of investors that haven't had access to these companies in the private markets that would really love to get a piece of these 3 businesses going forward. So I do think they need to tap into the public markets.
Well, that leads me to my next question, and I kind of want to draw on your history, your career history, particularly dealing with some of these early stage companies. Do you think this could have an impact on investment in the private space? The idea that if so much of money is now going to have to go to these newly publicly traded behemoths, do you think that would have an effect on some of the funding, or lack thereof maybe, for some of the companies in the private space?
I think it can cut both ways. I think that if these companies have successful IPOs, and as they access more investors in the public markets, they start to even continue to grow their valuation, it will actually bring more investors into the private markets, because too many investors have to wait for these companies to be multi-trillion-dollar businesses before they get access to them in the public market. So I think it's going to motivate investors to want to come into privates, to start to get a hold of some of these companies before they grow 10x, 20x in some cases or more in the private market. So I think it could actually be a boon to private markets, because I think more and more people are going to want to get into these companies at an earlier stage.
All right, Greg, really appreciate you joining us. Greg Martin there, Managing Director of Private Markets over at Rainmaker Securities. And we continue our coverage here and our conversation. We want to bring in Eva Ados. She's the Chief Strategist over at ER Shares. And Eva, of course, this was a long-awaited filing out of SpaceX. We had a little bit of a tease earlier today with some reports that OpenAI is prepared to file confidentially. Anthropic also maybe potentially coming down the pike soon. And that doesn't even count all the other names like Databricks and Cava, Stripe, et cetera, that be coming soon. What do you make of all this?
I think this is going to be, as you said, a very exciting year. We've been studying private and public markets for a long time. What we've noticed is companies stay private for longer, and a lot of that value creation that was previously accessible through the public market happens before the IPO. And that is the reason why we create the crossover XOVR ETF, exactly for your point, because retail investors are getting locked out of these great opportunities that happen pre-IPO. SpaceX is one example. You mentioned OpenAI, Anthropic. All these companies create so much value, and retail investors have been locked out for years.
Well, I am curious. I mean, SpaceX, obviously one of your largest holdings. Is there a sense here that there is room for everyone? The idea that, look, I mean, SpaceX comes out. We know everyone's going to buy it. But what happens when Anthropic comes out and OpenAI and all these other names? You're going to have some investors that are going to have to try to make a choice because there's only so much money to go around, I would think.
I love the question. I couldn't agree more. But I do believe there's winners and losers. And all these great companies have very popular names, but we believe not every of these companies is actually going to be a leader, a magnificent eight, let's call it. So we did a lot of research when we purchased our first private company in the XOVR ETF. That was the first time ever that an ETF had access to a private company. And we looked at many different companies. We chose SpaceX because it actually has a moat. When you look at OpenAI, for example, to us, it doesn't have a significant moat because LLMs are easily replicated. And unless you have the infrastructure to support and the data centers, it's very easily replicated. It's really hard to tell who the leader will be. So to us, SpaceX is a three-engine empire. That's what we call it. It has three engines. Each of them have their own modes. They're all interlocked. And we saw an example with the S1 today between XA and SpaceX. You can see that, or Tesla, you can see that this is becoming kind of an empire here. And each of these pillars have their own mode, and they're all interlocked and they work together. So that brings us back to the Carnegie and Rockefeller days when they controlled the whole supply chain, and their competitors had to use their infrastructure when it comes to oil or transportation or steel. Mm-hmm. And when you get to that point where your competitors need to use your infrastructure, and then you have a monopoly. Yeah. And okay, there's good and bad about this, but if you're an investor in SpaceX, that's something you want to see.
Ava, really appreciate you jumping on for us. Ava Otto's there, Chief Strategist over at ER Shares, our extended coverage on Bloomberg Television and Radio, which started off with those earnings out of Nvidia just about an hour and a half ago, expanded to a broader story about the broader tech space. So who better to end this hour with than the co-host of Bloomberg Tech, Ed Ludlow. You have a show, Ed. I think it starts at, 11 a.m. New York time, and it's 8 a.m. your time, which is early, and you apparently never leave the office. I don't know, what takes precedent for you tomorrow when you sort of come in and start your show? Are you going to start talking about Nvidia and Jensen Huang? Is it going to be about Anthropic, SpaceX? I mean, what is now the dominant story that investors should be paying attention to?
Are we laughing or are we crying?
We can do both, Ed.
Yeah, it's such an excellent question. The SpaceX IPO is probably more consequential, right? Everything that we learned in that document, from SpaceX's current financial health to what it is saying it can achieve in the longer term, right now it's more than we learned from Nvidia. We were very clear on Nvidia. This was a beat and raise quarter where the numbers didn't matter. There needed to be a new story, and you went through the numbers really well, but essentially nothing's changed for them, right? The status with China, the same. The outlook for aggregate spending on data center, pretty much the same. Mm-hmm. Vera Rubin, maybe that's ramping nicely. But the here and now is, I think that SpaceX tomorrow morning will probably be what's discussed.
I do want to get your thoughts, too. I mean, you live in San Francisco and work in San Francisco. There was a lot of talk a few years ago about how the center of technology was kind of moving away from Silicon Valley to other parts. But now we've seen kind of a gravitational pull back to the Bay Area. I am curious as to sort of what the mood is like that, particularly amongst sort of, forgive me for using this phrase, but amongst the tech bros and the other folks who kind of make up the economy out there.
Yeah, a lot of them in that industry are feeling immediate and massive economic benefit from what's happening. If you work at an AI lab, you're even in a private one, right? Your stock-based compensation and your RSUs have changed the game for you. And that's what's happening here. With SpaceX, also spare a thought for Southern California, Hawthorne, and all of the industry that's born out of it, right? There is a great ripple effect that's come from SpaceX in aerospace, defense technology, all these startups that are SpaceX alumni. Very core to this story too.
All right, Ed, got to leave it there. Appreciate you sticking around. Ed Ludlow, the co-host of Bloomberg Tech. I am Romain Bostic. I am actually the host of The Close, but you are now watching our extended coverage and listening to our extended coverage on Bloomberg TV and radio. Right now, of the top 10 stories on the Bloomberg terminal right now, 9 of them involve the tech space, primarily Elon Musk and the SpaceX IPO, and Nvidia and its earnings, and the build-out of the AI infrastructure boom. We'll have more coverage later here on Bloomberg Television and Radio. Stick around.